Good morning, everyone, and welcome to this edition of The Market. I'm Avan Dabash, and joining me right now, we've got Anisha Jain as well as Pankaj Podar. And what a day it was for the equity markets, as we yesterday saw a reprieve coming in. We finally broke that 5-day losing streak on the index, and supported by global cues as well as action within the large caps, we wrapped up the day at 17,136. For the Sensex too, comfortably in the green, 574 points higher. So we clearly seem to have regained a lot of that lost ground. Do remember the selling pressure has been awfully brutal over the past many trading days. So finally good to see some amount of reprieve or some semblance of normalcy coming in on the screen after being beaten down, particularly in the last two trading sessions when a lot of the large cap stocks bore the brunt of the sell-off. I'm talking about the Hdfc twins, which lost quite heftily, as well as those technology stocks. There's where you saw that recovery kick in. So it was a convincing recovery indeed. But that's being said, you still had the liquidity picture look rather wobbly, with the FIIs continually selling in the Indian equity markets close to 3,000 crore rupees after a hefty sell-off figure of close to 6,000 crores on Tuesday. But this morning, we're waking up to mixed cues when it comes to Asia. You've got Hong Kong as well as Shanghai that's on the back foot. Nikkei is in the green. And you've got the US markets, which as well are looking a little bit choppy. For the most part, it's looking like it's in the red, barring the Dow Jones, which managed to gain marginally. So yes, it's a strong start to Asia. The SGX Nifty is indicating a positive start. And Pankaj, we should hopefully continually see more green on the screen after yesterday's pickup.
That's what, Dow Jones, what's happened with other global markets tend to indicate this morning. Even if you look at SGX, it's up about 70, 80 odd points, and that is something which is being maintained. But of course, it can change as we go through the day. But no major negative cues except for what's happened with Netflix, how it has fallen and how it has led NASDAQ on the lower side. So maybe apart from that, there is no major negative cue that the markets have to deal with. Crude was broadly flat. Yields, after the rally that you've seen, have been how they are. FII selling number, however, continues to be high. It's about 3,000 odd crores. It used to be in the range of 6-7. So maybe, markets just take a relief from that. And more importantly, technology stocks actually managed to gain versus what's happening with the HDFC twins. HDFC also was broadly flat considering the sort of fall it was having. I think there was some sort of relief over there. But, cement stocks are probably the one to watch out for. So that's something which the street will look forward to. We can pull up ACC, Ambuja, and what really happened over there. So Anisha, finally there is some optimism coming in over there after ACC numbers, where probably they indicated a price hike and saying that, most of the cost benefit is probably passed on. That's what the street is assuming.
Oh, well, yes, cement stocks were definitely in focus, but don't forget the heavyweight Hdfc twins and what's happening with the entire banking space, because now ICICI Bank trades at a premium compared to HDFC Bank, and this is on the estimate price to book basis, and this is the first time it has ever happened. We have seen the sharp declines in the Hdfc twins. In fact, they are trading very close to the 52-week low levels. They did manage to bounce back a tad bit, but having said that, it is the Hdfc twins which have been pressurizing the market. And you were talking about technology stocks, Pankaj. We'll have to wait by and watch what will be the impact of that on the Indian markets, because we have seen that the valuations were quite expensive even in the technology space. So we'll have to watch out for that, because valuation-wise, even the Hdfc twins are something that we are watching out for. So that's the key thing to track as far as the banking space is concerned. But we also have a couple of numbers and earnings to watch out for. So HCL Tech will be reporting its numbers from the IT pack. It's a seasonally weak quarter for the company. The expectations are not very exaggerated. So we'll have to wait by and watch what the company delivers. But the expectation is that it is going to be a very soft quarter coming in for HCL Tech. Nestle is also likely to report its numbers, one of the big FMCG majors, which is starting off with its earnings. The commentary regarding the rural demand as well as inflation and the impact it's having on demand will be critical to watch out for. We are also watching out for Nykaa, because that one has entered into a partnership with Aveda, and they are now starting some retail stores when it comes to the salon. So that will be very important to watch. And we are also watching out for the US stocks, because we saw the huge decline that we had in the Netflix that we were talking about.
Absolutely, but HCL and Nestle probably the big ones to watch out for. There are some other names like Tata Communication, ICICI Lombard, all of that are pretty well tracked. So, that is something which of course the street will focus on. But just highlighting the global markets, Dow Jones was up 0.7%, Nasdaq down 0.06%, Nasdaq down 1%, S&P absolutely flat, and some of the other markets were broadly in line. You had commodity like crude was at 102, Brent oil at 107 odd level. Silver was also slightly on the positive side. In fact, let's go ahead and hear out some of the voices that we spoke earlier, whether it was Aditya Narayan or Samir Arora, on various stocks or sectors that they like.
To us, all experts nowadays, is whether you would now buy HDFC Bank, given the massive fall that they've had.
Yeah, we would. We would.
Right away.
Yep.
You'll buy both. You'll buy both or you'll buy one?
Sorry? No, we'd buy both. I mean, in many senses now,
or
because you have a set major ratio. Yeah, they'll go hand in hand.
No, but let's look at it from a medium-term perspective. The return ratios, which is what analysts and markets look at, return on capital and return on equity, for HDFC Bank comes down. For HDFC Limited expands.
And Nico, if I might just excuse myself on this one, we are a little, we have some restrictions on the stock, so I won't be able to delve deeply into it going beyond our recommendation.
No, actually, on financials, the thing is that this angle was always there. Even we are mostly overweight in financials, that there is a high ownership. And when, for many years, when HDFC Bank and all are not in the MSCI index, and in 2013, it was the #1 biggest company in the index. And then it was removed because of reaching foreign ownership limit. So we all never sold. Maybe others also obviously didn't sell. And for many years, therefore, it was not in the index, whereas the funds had it. And therefore, it helped the funds because the stock did well. Now, for 2 years or 1 year, when it initially didn't do well, the fund managers would have felt completely the opposite, that it is not in the index. And therefore, it is not hurting the index, but it is hurting individual fund managers. So they have sold. Now, we are also stuck in some of these things when we know that fundamentally the company is improving every quarter, the growth rates are back, some of the issues are over, but there is a technical overhang, which actually can stop, because it was the same overhang was not there for 5 years when it was again not in the index, but funds had it. So we still hold it because we say it's part of our portfolio where you can handle a stock which is doing well fundamentally, but becoming cheaper every day. So we continue to hold this financial. I think it's basically a story of 2-3 financials where it's sort of a buy for everybody and it's not done well. But others, ICICI Bank, State Bank, how well they have done in the last 1 year or in 2021 separately, or if you do it rolling 1 year. We have no problem with that, and we don't care whether other funds are selling financials or not.
All right, let's move on then. And another cluster that has definitely been in the limelight of late has been the cement basket. You've had a lot of news as well that's been brewing within this space, but let's just break it down as to what have been some of the key triggers that have been driving growth within this space. Reports as well are indicating that cement demand could grow by 7 to 8% to close to 382 million metric tons in the current fiscal. There's a lot of tailwinds, such as strong demand coming in from rural housing as well as infrastructure sectors. You could also see the high input costs and inflationary pressures that may play spoil sport, but in general, we've seen the overall sales which have picked up even for a cement player, a large cement player like ACC. You had the RMC revenues which grew about 10% on a year-on-year basis, 20% sequentially to about 400 crore rupees. The company in specific is targeting 40 million ton capacity via their ongoing projects for mid-CY 23, and expansion as well is looking strong. Not just that, a lot of the cement companies recently have undertaken price hikes, 15 to 50 rupees per bag, in order to mitigate the cost escalations. So that too is helping the overall in order to mitigate the impact of the input costs, which have been biting some of these companies. And then, of course, the big news that has been surrounding the entire cement space domestically has been Holcim's India exit. And the latest reports seem to indicate that Carlyle as well as the JSW Group are going to join forces in order to bid for ACC Ambuja. We understand that as of now, the JSW Group is in discussions with Carlyle in order to back this bid, and JSW could raise close to 18,750 crore rupees from PE groups, which will be backed by JSW, and they could submit a bid within a month or so. So that's definitely going to be of a lot of market interest and what the street will closely be eyeing. But let's also talk about the rebound that we witnessed in trade yesterday. Jayesh is here to walk us through the trade setup, important levels to track on the Nifty Bank, the frontline index as well. And Jayesh, good morning. It seems like the SGX Nifty is pointing towards a healthy start. And yesterday, after 5 straight days of selling pressure, finally in the green.
Good morning, Aman. Absolutely right. Today could be a green day given the SGX Nifty's texture as well as the FII positioning, which is extremely important to track at this moment. Yesterday, we saw that call writers have unwound nearly 3,000 contracts, whereas put writers have added almost 40,000 contracts, which means that, you know, the FII positioning is definitely on the bullish side. Talking about the two frontline indices, there was clear-cut divergence that we got from both the Nifty as well as the Nifty Bank, despite the fact that both of them made an inside bar. However, that inside bar on the Nifty was on the bullish side, whereas on the Nifty Bank, it was on the bearish side. I wouldn't say that we are still out of the woods yet because the Nifty is still facing resistance at its 200-day moving average, and the Nifty Bank has been facing resistance at its 50-day moving average. Talking a little bit about the broader market indices yesterday, both the Nifty Small and the Mid Cap Index underperformed, and the advanced decline ratio was bang in the middle at 1:1. A few sectors that have shown relative strength by gaining this week have been the Nifty Energy, Auto as well as the PSE Index, which need to be tracked closely in today's trading session.
Well, I got stuck in the Mumbai traffic, but it's so...
Welcome to Mumbai then.
It's the first time I'm in a studio since March of 2020.
Wow, that's a long time. So we are honored to be sharing this space with you when you are just...
I'm just so excited. I don't think I'm going to be able to handle it.
Well, I'm sure we'll have to handle it well, because the other big news is that the IEC is kickstarting today. So that's the big event that we are watching out for. And that's the biggest and the most important event of the year, right? And it's a whole host of stalwarts that are joining us today and tomorrow as well.
That's right. It's once again time for the Times Network India Economic Conclave. And ladies and gentlemen, look on your screens. It's a star A lineup. We're going to have the who's who from policymakers, corporates, market men.
Let's take it straight then to the top 5 stocks that we'll be closely eyeing in today's trading session. Let's begin then with Angel One. We'll be looking at that one with respect to its earnings. The Q4 PAT came in at 205 crore rupees versus 102 crores, a huge bump up there. There was a $1.5 million gross client acquisition as well, which was up nearly 9.8% QOQ. You have the overall equity market share, which grew 20.9%, and the F&O market share as well that grew very smartly. Meantime, it's going to be Nykaa in the limelight as the company has partnered with Estee Lauder's Aveda. They're going to be launching premium salons in India and making their entry into the professional beauty services segment, which is going to be branded as Aveda Nykaa. They're going to offer luxury professional hair care services, among others. And this is going to be the first co-branded salon that has been launched in Bangalore. Do remember, the beauty and personal care market in India is sized at close to, 1267 billion rupees in 2019 and has the potential to grow close to 15 to 30% CAGR. Meantime, the street will also be keeping a close eye on earnings and closely watching out for what HCL Technology delivers when it comes to their quarterly numbers. The street is anticipating that there could be a dollar revenue growth which will be flat at about $3,005 million. Revenues are seen flat. Profits could decline about 2.5% to 3,350 crore rupees. A moderation in cross-currency growth. The core services business could see strong momentum, and we are expecting a change in the overall business mix. We'll also be watching out for what Nestle delivers in terms of its earnings. The expectation is that we could see profits increase by about 13% on a year-on-year basis to 610 crores. EBITDA is seen at 940 crore rupees. A broad-based domestic growth is anticipated, but the higher agri-inflation is going to be a bit of spoil sport. Volumes could as well be dented, and we will be watching out as to how freight costs as well weigh on their overall margins. So that's something that the street is going to eye. And then there's Reliance Industries. Morgan Stanley has maintained an overweight rating with the target price raised to 3,253. Energy security is a key issue for policymakers. Value creation, they believe, will form a focus on energy security, and they believe that the tightness in gas and rural refining markets is going to be a huge positive. And of course, Reliance Industries has been a clear winner in the past many trading days. Those are your top 5 stocks. But Nayantara, welcome to the Mumbai studios. I'll catch you at IEC, that event. But for now, what about what our chartists are flagging off in terms of levels and top stocks to watch?
That's right, Aman. I think you and I are going to meet after about 2 years. I am certainly looking forward to that. I've already met Anisha here in the Mumbai studio. And now I'm going to toss it across to my colleague Ajay Sharma, who's joining us live from the venue, the NCPA, which is the venue for the Times Network India Economic Conclave. And Ajay, the India Economic Conclave just gets bigger and bigger every year.
With each passing year, Nantara, that's right. We will be catching up here later in the day, but I'm so excited because after 2 years, the galaxy of corporate India would be swooning down to this extremely premium venue, NCPA in Mumbai, and that too we'll get to meet them face to face. Gautam Adani, Sunil Bharti Mittal. In fact, the focus will also be on the vaccine man, Mr. Poonawalla. He'll also be around. Top quality ministers who've been handling thick of action, even challenging times. The oil minister, aviation minister gonna be here. A lot of personalities internationally would be here. Gautam Adani, of course, and Sunil Bharti Mittal from the corporate side, very reticent people. We'll get to hear their views. And Hillary Clinton will be coming down. So very interesting. And guess what? My favorite, the person who I am really looking forward to catch up for sure on the side of this massive event is Nawazuddin Siddiqui. What a star that guy has become from being an underdog. So it's going to be 2 days filled with, thought-provoking insights coming in from top corporates, international personalities sharing where India is heading and how India is really taking center stage on international scale, not only in the economy front, but also as a major stakeholder in many international issues. Geopolitical issues. Look at how all 5-7 ministers have come down to global ministers internationally. All of them have come down to India in the last 15-20 days. India is not what it used to be last couple of years back. And this is the stage where all these key ideas will be thrashed out, agenda will be made, and discussions which are the country, citizens and our viewers, all of them can benefit from listening to all that action on ET Now and ET Now Sadesh. So it's going to be, and of course market, how can we forget that? Prashant Jain, Nilesh Shah, Shankar Sharma, all of them will be discussing their views on how market is really analyzing and heading from here on. So it's going to be action-packed, very interesting 2 days, Tantara.
India Economic Conclave, which will be going live in a couple of minutes from now, from Mark Mobius to Shankar Sharma to Prashant Jain to Nilesh Shah from the markets to, the top policy makers that are coming in from New Delhi to the best of corporates. And Guy Tonde, which is who Ajay Sharma clearly is watching out for. We'll also have Randy Zuckerberg, incidentally. Ladies and gentlemen, it's 2 days, action-packed and in person. Very few virtual sessions.
Oh, well, yes, and that's the most interesting part, because after 2 years, we'll get to meet all the management, understand what's happening on the ground, and there's a plethora of really stalwarts there, which are there. I'm watching out for some of the names, and there's some big names like Sangeeta Reddy, as well as Jyotiraditya Scindia, which will be joining for some of the discussions. We also have the head honchos at Maruti joining us to get a sense of what's happening on the ground.
It's action-packed, ladies and gentlemen, action-packed. We've got enough of a sneak peek, and we'll top it off at the night with Guy Tonde himself.
Okay, but let's talk about markets as well, because we have to do a technical check with the techies as well.
Yes, and Kunal Bothra, I am where you're supposed to be, in the Mumbai studio. I hear Nikund asking you and Naresh every other day when you're going to be in the studio. Today, I'm in the studio from Delhi. And Kunal, let's begin with you and back to the serious stuff. What's your expectation from the markets when you look at the charts today? What's on your radar?
Good morning, Antara, and I would also probably give you a welcome to Mumbai studios. So coming to the markets, I believe yesterday's recovery was one of the key features of the markets, which indicate that we could probably have formed a near-term bottom on the indices. So day before yesterday, when that brutal sell-off had actually happened for the indices in the last hour or so, we managed to trigger a lot of stop losses, a lot of put writers. They managed to unwind their positions, but I believe now we are at a point where the markets would probably have established a strong base at the 16,800 odd mark for itself. More importantly, there are two distinct features of the markets which we have seen in the last 1 or 2 weeks. Is the mid caps still showing signs of strength. There are a lot of mid cap names which are still showing signs of strong momentum. Many mid cap stocks have come back to their 52-week highs. Some of them have even crossed the lifetime highs in this last 1 or 2 weeks. So that tells you one end of the market, which is not at all perturbed with what's actually going on, with the large cap names. And the other, of course, is the large cap stocks, where there have been some sharp corrections, whether it's the likes of HDFC Twins, the IT stocks, etc. But I believe that we could now get into a phase where the large caps may as well start to get into a strong recovery phase. So keeping that outlook, expecting the Nifty to move up hard to 17,400, 450 over the next couple of days, would suggest a couple of buy calls. The first one, which I'm suggesting, is one Ambuja Cement. I think it's a classical chart in the making. The stock had a fabulous rally in the first 10 days of the month of April. Then, for the last 2-3 days, the stock went into a patch of consolidation, and yesterday it managed to just about eke towards a breakout of this consolidation. So the chart patterns are looking very positive for Ambuja Cements, would suggest a buy. 400 as a target, stop loss to be kept at 364. And HDFC Limited, as I reiterated yesterday, that the stock has come back into deep oversold territories, and the risk reward to enter the stock at current levels is extremely attractive. So would suggest or reiterate a buy on HDFC Limited, targets of 2,300, stop loss 2140.
Okay, Kunal, so those were some top bets coming in, and of course Ambuja Cement, given the entire interest that we're seeing in the cement space, is definitely interesting. And HDFC, I'm really surprised to see that name, given the fact the huge underperformance we have seen from the HDFC Twins, and Bajaj Auto is the other one that we'll talk about in a bit as well. But Naresh, first up, I wanted to get your sense what's happening with Reliance. That one is bucking the trend, and in the last 2-3 sessions it has piled on gain of around 6-7%, and now we have a brokerage also talking about a target of 3,200 on that one. What is your sense? Where is that one headed?
So the view is very clear in Reliance Industries. So if we look at it, was the first phase of the move was from March 20 to September 20, peaked out at 2250, 2300, went sideways for the next whole year, then made a breakout move to 2750, retested that 2250 mark, 2300 mark. Again came back to 2690 levels just a week or two back, made a dip, and now again making that move about 2700. So this is the next leg of the move, wherein given that the last range was say closer to 400 points, so I would expect a move to 3100, 3200 before it takes a pause. And now the last 2 days were price moves along with volumes as well as relative strength with the index. Now, this is the time where it becomes a new start for the trend. So out here, expecting a move to 3100, 3200 and every dip to be a buy with a stop loss below, say, 2580.
That was about Reliance, but what are your top picks and what do you make of the underperformance that we have been seeing in the banking space as well?
So the underperformance in banking space is to stay here till the time we don't see a change in HDFC Bank and Kotak Bank. HDFC Bank has come down to oversold levels and very important support. So 1300, 1330 is an important support. The recent low was around 1290. The low for the last 1 year is around 1300. Pre-COVID, it used to trade at around 1250 odd. So it's come down to an extremely important support as well as oversold zone. So there could be some bit of a bounce back. But it's still far away from taking leadership. Same as the way with Kotak Bank struggling around that 1700 mark, whereas the rest of the large cap banking space is just 5% away from the 5 to 10% away from the previous all-time highs. These two large names are almost down 15-20% or even more from their all-time highs. So till the time we don't see leadership in these two names, which have a very decent weight in the index, we are going to see stock-specific better performance in the rest of the banks. The two stock picks for the day. First is a buy on BPCL. The stock has been sideways for a long period of time. What we are seeing is a short-term breakout, and we've seen that breakout happen in the refinery space in MRPL, Chennai Petro. I think the next leg of the move could happen in the OMCs. So yesterday it did cross above that 388, 390 mark, which was the short-term swing high. Expecting a quick move to 430, a stop loss at 380. Second is a buy on UPL. This is more like a longer-term bet out here. The stock has made 3 to 4 tops around 820 to 850. Very recently went down all the way lower, made one of the fastest recovery in the short term. So setting up for that big move above the 820, 840 mark would eventually head up towards 950 and 1200. So looks very interesting at current levels, preempting the breakout.
Much for flagging off those top recommendations. Those are our chartists running us through their fresh bets this Thursday morning. But our managing editor Nikunj Dalmia as well joins in. And Nikunj, just looking at the trade setup, yes indeed we did stall 5 straight days of relentless selling pressure. We witnessed a rebound led by the large cap financials as well as what we saw within the IT basket. But the question is this going to be just a flash in the pan move, or is it looking a little bit more sustainable?
Aman, my sense is that we are not going through a phase of acute pain or a lot of excitement. Markets are likely to settle into a range. The first half of April was in a sense full of excitement. FIs were buying, DIs were buying. The markets were oversold after that, after concerns around inflation, after concerns around war, after concerns around crude. So an oversold market in the month of March managed to bounce back in the first half of April. The second half of April solely belongs to earnings adjustment. It solely belongs to what will happen in a sense to commodity prices and margins and demand trends. I'm afraid the initial setup numbers are not pointing to any kind of an earnings upgrade cycle. If at all, the earnings upgrade cycle will get challenged, which in a sense will arrest the uptick for the market. Now, why markets are unlikely to fall a lot also? Well, that's largely because you've got domestic institutional investors who are buyers now. Money is rotating beautifully. Banks came back. Reliance has made a comeback. So the downside for the market will get restricted, but the upside also I think is very capped. But the problem is that now mid and small cap stocks are showing signs of cracking, whether it is liquid mid cap space, HNI dominated mid cap stocks. So that's the space you got to be a bit wary of, so what I'm trying to say is that let's say 65 to 70% of the market in the first week of April moved higher. I think that number will come down to 15-20% now.
Nikunj, what we need to watch out for also is the cement stocks that have been buzzing in trade. Over the long weekend, there was news of that big deal where the Holcim is going to be exiting the twin cement-listed stocks of ACC as well as Ambuja, but the entire pack, which is enthused.
Yeah, it's made a comeback, and I don't think it has got to do with the deal buzz In general, I think the market view is that the worst of the energy shock is behind us, which is what happened on the coal front, what happened on the energy front, what happened on the on the front of, let's say, transportation cost. All that may well be behind us. I don't think this quarter would be a good quarter for cement companies, because cement companies in a sense have suffered a lot. But what I understand, and if you speak to some dealers and if you do some channel checks, is that cement demand has been quite resilient and price increase could happen. So you could have a situation where price increase may actually kick in, and if commodity prices they reverse, something on the crude front, something on the coal front, then some of the cement companies actually could be in for good gains. One thing is very evident, Nayantara, that cement companies are not running into any kind of a demand disruption. Unlike autos, unlike FMCG, where demand disruption has been the more painful part rather than margin compression, for cement I think that is not the case. Even in commodities, even for that matter power. So you look at any of the big commodities, especially industrial commodity, they are not showing signs of demand destruction, be it on the metal front, be it on the power front, or be it on the cement front. That may just give market a cue that if you want to play a contra bet right now, maybe cement could be a contra bet. The problem with cement is that it's expensive. By any yardstick, if you look at the enterprise value of even ACC or a Shree Cement, barring India Cement and JK Cement, I think rest of the pack, I think is quite expensive.
Cement might be a good contra bet, but continues to be very expensive. But I'm really intrigued to hear your views with what's happening in the banking space, with now ICICI Bank trading at a premium versus HDFC Bank, and this is the first time ever it has happened on the price to book basis. Nikunj, do you think this trend is going to be sustainable with ICICI Bank leading from the front now?
Yeah, we've been maintaining this view, Nisha, that in the short term, while HDFC Bank is one of those well patronized, well discovered and well owned stock, I guess the puck has moved towards ICICI Bank. Look, ICICI Bank has managed to repair their balance sheet, and now they are participating fantastically well in a new credit cycle. Along with that, the subsidiaries are firing full cylinders. So if you frankly look at what ICICI Lombard is doing, how ICICI Securities is moving, all the subsidiaries are actually firing full cylinders. Unlike for HDFC Bank, where you have this entire merger challenge, you have this FI ownership challenge, and in the near term, you also will have to reposition HDFC and HDFC Limited in your portfolio if you're a global investor. Unlike ICICI Bank, where you're getting a bank which is growing, gaining market share, worst of the NPA cycle is behind us, and the best is yet to come, and subsidiaries are filing full cylinders. You look at any of their subsidiary, I mean, they are really doing extraordinarily well. So you put all those factors together, then you're getting more clarity and more comfort with ICICI Bank in the near term. Bear in mind, if you look at the 52-week change, ICICI Bank is a ranked outperformer. But if you stretch it up, let's say if you look at the lean period, the post-Chanda Kochar issue, ICICI Bank went through a unusual compression. So first normalization has happened to the stock, and now expansion is happening, given that other banks have their own challenges.
Normalization to expansion in ICICI Bank. Thanks very much, Nikunj, for joining in and assessing all of those key points that the market will closely be keeping an eye out on. But Reliance Industries want to look at the one-week chart because it's been a pretty phenomenal move. And to add to that cheer, Morgan Stanley this morning has maintained its overweight rating. They've upped their target price. They're very bullish on a number of factors. Let's find out why. Sumit joins in with all the details. Morning, Sumit.
Good morning. So Morgan Stanley on Reliance Industries have maintained their overweight rating, but have hiked the target price to close to 3,253 rupees. Now, this is the highest target price on Reliance Industries on the street. Now, the brokerage is bullish on the energy security because that's in focus from the policy makers, and it believes that hydrogen will play the next major role in the upcoming energy transition of India. And because of this heightened awareness of energy security in the country, Reliance Industries' new energy business is expected to benefit out of this, and this will also fund the growth for this new energy business. Now, it believes that the company's net asset value could be boosted by nearly 10% on the back of this new energy business, and given the fact that there's a tightness in the refining market and in the gas market, the company's old energy business that is expected to benefit, and that will be funding half of the capital expenditure required for this new energy business over the next 3 years. And because of this, the company's debt is expected to remain range bound. Now, it also says that The current share price is implying a zero value when it comes to this new energy business, and going forward, Street will start to factor in this new energy business, and because of which there could be a rise in the share prices, and hence they have upgraded their target price to 3,253 for Reliance Industries.
Thanks very much, Somit. We'll be watching out for RIL for sure in today's trading session. But another stock that you want to keep on your radar is going to be JB Chemicals. Credit Suisse has come out with their latest brokerage note saying that the consolidated EBITDA can more than double for the company in the next 5 years. What else do they have to say? Let's find out more from Sharad. Morning, Sharad.
Good morning. Especially Credit Suisse has initiated a buy rating for the stock JB Chemical Pharma, and the target price is coming in at 2,020 rupees per share. They did mention that it's a very fast growing business and it's a proper high ROC business is coming in for the Indian franchisee business. Now the investment theme in the Indian business remains strong, as the brokerage has stated, and almost 60% of total EBITDA contribution for FY22 has come from the Indian markets itself. So it's a very strong push on the domestic front, and they're also expecting their overall growth as well as the rate of capital employed being higher than the peer set itself. And of course, they did mention that the EBITDA will double by almost 5 years. Now, do remember the stock has given flattish returns over the 6 months period, but the mutual funds have actually increased their stakes, increasing from 13.75% to almost 14.27%, while even FIs have increased their stake by almost 0.1%.
Thanks a lot for joining in live with us. That's the word coming in from Credit Suisse. Deepan Mehta of Elixir Equities now live with us on the market. Good morning, Deepan. This is Nayantara. What a roller coaster ride we've been having for the markets, right? So before I get sector specific, as well as talk to you about new trading ideas, etc., tell me, last couple of sessions, what is it that you've been doing? What have you been telling your clients? When you see the kind of moves you've seen this week on Infosys, HDFC Twins, obviously, I'm sure your clients get concerned.
Good morning, Nayantara, and thanks for having me on your show. I think not just last 2 days, I think the last few weeks have been challenging. And clearly, I think we are not in blue sky scenario what we were a few months ago. And there are many challenges on geopolitical side, on corporate earnings front, and then there's relentless selling coming from the FII. So we are in a very challenged terrain at this point of time. And also the earnings season is coming up and results should start coming in thick and fast. So in my experience in the market for the last 2-3 decades, I realized that the best time when there's so much of upheaval happening is to just wait it out and just be on the sidelines and look for investment opportunities where stocks have corrected significantly and long-term fundamentals are still intact and you have some valuation comfort. So, I don't have any stock in mind because the earnings season will start and that's the time when we can really analyze what has happened for the past year and what the management commentary is and take a perhaps more well-informed decision. But for the time being, I think it's just best to stay on the sidelines and let this particular volatility play out. I have noticed that in the past, when you try and trade in such a market, you invariably end up making mistakes. So it's just best to wait and watch.
Are you waiting and watching, Deepan, and just the kind of moves that you saw on HDFC, HDFC Bank, as well as Infosys? Did you use that as an opportunity to enter, or how would you approach these stocks? What's your recommendation?
See, the problem is that most people, including us, are already well invested in Infosys and HDFC Bank. Now, whether you have HDFC or HDFC Bank, it's the same thing. So it's just a disappointment to see your notional profits get compressed because of the decline which we have seen over the past few trading sessions. And maybe there's a one-off soft quarter. That happens in investing, especially long-term investing. You have to live with such quarters where managements miss estimates for transient reasons. Nothing major has gone wrong in the long-term trajectory as far as growth and earnings are concerned for both these companies. So you just live out this kind of a mild bearish period and hope that maybe next couple of quarters turn out to be better than what we have seen in the last quarter. And markets eventually will recognize that and stocks will start to regain lost territory. So if you're a long-term investor, you have to be prepared for maybe 2-3 such soft quarters. But eventually, I think these are great companies. Managements are taking long-term view and long-term strategies, which take perhaps some time to play out. So I'm not that concerned about the correction in stocks. But as I said earlier, we're not buying into them because more or less we and our clients are mostly invested. So there's no scope in terms of individual stock weightage to extend our holdings over there.
Dibin, if I look at the large cap IT and mid cap IT stack, just P multiple, a very crude way of, or a very elementary way of looking at valuations. Most of the mid cap IT stocks, at least the ones which are large and liquid, whether it is Mindtree, Persistent, even L&T Twins, they are trading at a premium to Infosys, Tech Mahindra. Now, will that sustain? When the rally in the IT started, these were high growth mid cap companies. So markets said, okay, growth is high, P multiples will remain high. But now growth is contracting, margins are contracting. Can markets justify this gap where large cap IT is trading at a discount to mid cap IT?
Absolutely, Nikunj. First of all, good morning. I don't think that this valuation gap is unjustified. If you're going to have higher growth rates with similar level of corporate governance, balance sheet standards, return ratios, and capital allocation policies, then mid-cap IT will continue to trade at a premium to large-cap IT. And what also has happened, Nikunj, is that now these mid-cap IT companies have been around for decades. And the clients and the overall technology space has recognized their role. There was a time when large companies, Fortune 500 companies, would favor only the large cap IT, global IT companies. But now they are seeing merit in giving projects, even transformational projects to mid-cap IT companies which have a pricing advantage, which have a technology edge, which are more nimble-footed, and which can offer more value for money for such clients. So I think that's a level of maturity as far as tech spending is concerned. And I've been watching this sector for the last 15, 20 years, and it's the first time I've seen that mid-cap IT is on a sustained basis growing at a rate much faster than the large cap IT. And this time I think this may continue for a few more quarters. The small size certainly benefits them because even if they get $50, $100 million contracts, it makes a big difference to their quarter-on-quarter and year-on-year growth rates. Whereas the likes of TCS, Infosys now really need billion-dollar type of deals to make the needle move. And that I think plays out in favor of mid-cap IT. And because of scarcity value, because of the great track record which they have, and excellent communication, good level of guidance and understanding, I expect that mid-cap IT will continue to trade at a premium. But for the record, mid-cap IT also has corrected significantly. And if you look at the trailing 12-month P ratios, or even what is forecast for next couple of years or so, they're not as expensive as they were maybe a month or 2 months ago at the peak of 18,000 thereabout where the Nifty was trading. So they have been in corrective mode. And give, I think, 2-3 quarters or so, if mid-cap IT remains at these levels, you will have many analysts coming and saying that, look, now they are at reasonable valuations, almost attractive valuations, and are great investment prospects. The key thing is visibility, visibility of earnings, and sustainability of this earnings growth for the next several quarters.
We can't take our eyes off of cement. That is where the real big buzz of a block deal is there. Holcim could be looking at exiting India after 17 years. Remember, Holcim is a Swiss company. They bought into Ambuja and ACC. They are the majority investors there. They invested in India about 17 years ago. And if they're looking at indeed exiting India, which could be in line with the global strategy, that will change the contours of how cement as a sector would trade. Then we don't know whether the deal will go through or not. Holcim has said that, look, they're talking. It may not necessarily translate into a deal. But if the deal goes through, what do you think it means for the cement sector? And what do you think it means for the smaller cement companies?
Because, there's no point in speculating as to what will happen because the new owners of this company, if at all, also do matter. For example, if an existing large cement player acquires these companies, then it'll mean more consolidation and even better price discipline. Already the sector is legendary when it comes to pricing and price discipline. So if an existing player takes it over, and there are many who can, who have the financial wherewithal to take over such a company, then it changes the dynamics for the cement industry for the better. If it's a private equity also, then also I think it's perfectly fine. But all I can say is that any change of ownership in ACC and Ambuja will be beneficial for minority shareholders. Both these companies have lost ground over the past decade or so since Holcim has taken over. And what really is required is more entrepreneurial drive, more aggressive strategies on the part of these two companies in order to regain lost market share and grow at and above industry growth rates. And both these companies have got excellent assets. They've got a good distribution network, very good brands. It's just that management aggression, I think, was lacking, and we saw many players, which were well behind ACC Ambuja, having grown their capacity significantly and gained a lot of market share. And with change of ownership, least one can expect is a change of that particular scenario.
Okay, Dipan, let me actually toss that question to Naresh as well. What is your take, Naresh, on the entire cement pack? We've already seen Kunal giving one of his top bets as Ambuja Cement. Would you concur with the view? Which are your top picks from the sector?
So the problem is not very gung-ho on the cement space, because this is a sector which is not the most well placed in terms of momentum. It tends to go sideways also after a big move. So out here, I would wait for a little bit more time. We've seen a good 15-20% bounce back recently in some of the large cap names. At the same time, we're not seeing a similar momentum in the small cap and the mid cap cement names. So this is more like a move which is happening because of some bit of announcement around that wholesale selling, etc. So such a trend, I would not like to participate. So I would wait out because the trend is not secular across the whole cement pack. So out here, there will be selective moves. Maybe an Ambuja takes leadership, but Ultratech does not make a similar momentum move. Or some other mid-cap cement goes sideways. A Shree Cement does nothing. So this sort of trend is tough to capture. So I would not like to participate. So I don't have a strong view on cements as such.
So that's a technical check coming in on the cement pack, not too enthused at the moment, and would suggest to sit on the sidelines. That's the word coming in from Nurej. But let's move on and get you the top fundamental idea of today. Today we are joined by Himang Jani, who shares some of his top defense bets. Remember, the sector has been seeing a lot of order booking of late. We have heard positive commentary from the government as well. But would this materialize into good earnings and better valuations for the defense companies? Let's hear out the rationale from Himang Jani on the same.
Globally, across all the countries, there is a clear-cut shift in the kind of spend that they want to do, the kind of indigenization that they want to do. They want to reduce the dependency, so on and so forth. Secondly, notwithstanding this recent Russia-Ukraine issue, if you see the government focus, almost about 2,851 items have been identified which can be procured from abroad. There is a greater focus in terms of giving out contracts. There is a greater focus in terms of exports and other reforms which are required. The government is going all out to do all of that, which is again, great positive news for the sector. And in terms of market cap and the allocation, I think people are very, the allocation is far too less. So I think there is an opportunity, and we do like some of the names. So Bharat Electronics is something that we like, which is a relatively, mid-cap size company with a good, sound, consistent track record, etc. So if one is looking to have some allocation for the, defense opportunity, BEL would be one stock. Apart from that, names like Bharat Dynamics, HAL, BEML, these are the names that one can definitely look at.
Two results for the day then, and Nestle will closely be eyed in terms of its quarterly performance. How will the volume growth be impacted on account of the rising inflationary pressures? What can we expect in terms of headline numbers? Well, Vinny has all those details. Let's take it across to her. Morning, Vinny.
Nestle is set to post its Q1 current year 22 numbers, and when you expect what is expected, it's a moderate set of numbers that we're expecting. Revenue growth is expected to be at around 9%, broad-based growth mainly led by out-of-home consumption, but it'll be more of a pricing-led growth than a volume-led growth because of the price hike that the company is taken. And mainly due to cover up for the inflation. So obviously they've taken price hikes. So pricing-led growth, then a volume-led growth. We could see a bit of a slowdown, marginal slowdown coming in the volumes for the company as well. Now talking about the bottom line of the company, the profits is expected to see a growth of around 1%, a flattish almost growth of around 1%. And when you look at the margins of the company, EBITDA margins 23.8% versus 25.8%. A contraction of 200 basis points is what we're expecting in terms of margins. Obviously, what is impacting the margins? Inflationary pressure, raw material costs being high, freight costs is quite high as well. It's increased a lot. So all this is surely something that will be impacting the margins of the company. Other than that, in terms of that, we'll be watching out for the commentary in terms of what the management is saying on rural demand. Is there any sort of a slowdown that we're seeing coming in there? Other than that, watch out for what is the commentary on inflation, price hikes, what are they expecting in terms of input costs, new product pipelines, what is the expectation there, as well as how is the demand trend coming in for packaged food are the main factors that we'll be watching out for in terms of commentary.
Thanks very much, Vinny, for flagging off those details. Well, autos were clearly in top gear, and in fact, you had a lot of those auto majors that drove gains yesterday in the session. And Deepan, wanted to just understand your thoughts, because there is a lot of potential going forward within the auto space, but then the concerns remain in terms of supply side issues, semiconductor shortage, a fall in rural demand, and how the auto sector can really come over this speed bump or this hurdle. How easy do you think it would be?
See, I think some segments in the auto industry are already doing well, and some companies also are performing quite well. So within the segments, I think commercial vehicles have already growth has picked up very well over there, and the likes of Ashok Leyland, I think, have seen good performance coming through, and they're not that much impacted by the semiconductor shortage. It's a matter of time before the likes of Maruti and Mahindra start, showing meaningful growth rates as base effect comes into play and as they start to manage their supply chain related issues. Across the board, auto companies have taken price increases in a gradual manner, so they are trying to get their margins back to what they were prior to this inflationary surge. Our top pick remains Eicher Motors as well as Maruti. Again, usual disclosure that we and our clients are invested. And we feel that once there is more visibility as far as supply chain issues are concerned, both these companies are sitting on very good order bookings, and volume should certainly pick up. In both these cases also, exports are doing pretty well, so that provides a new avenue for growth for these companies. And valuations are at reasonable levels. All along, I think auto companies have underperformed significantly, and it's a very critical sector with high growth dynamics, good underlying fundamentals. It's only a matter of time before these companies start to deliver decent growth rates, and that would pull the P multiples also higher. So generally positive on auto, and the best picks, as I said, remain Maruti and Eicher Motors, which have excellent products and many other positive strengths going for them.
Right. Kunal, if I can come to you, you have been talking about this, so that's the reason I'm posing this question to you. If you were to see the volume buzzers of yesterday, or even those that saw extraordinarily high deliveries, once again, you're seeing a bunch of PSUs led once again by MRPL 2 days on the trot. Yesterday, you were talking about how it was on the verge of a breakout. MRPL today, what would be your assessment?
So yes, in fact, Nayantara, yesterday many of these other stocks, MRPL, I was looking at actually, stocks like Chennai Petro, these stocks had done fabulously well. So this month has been a month where you've seen many of these, petroleum kind of stocks for themselves have given a big breakout. MRPL this month, I think, is around 65-66% up for itself. It's not just a percentage rise for the stock, but this comes out after almost 2 years of a very tepid kind of a rally for these stocks. So, from the pandemic lows, there have been so many kind of stocks and sectors which have done exceptionally well. But, these kind of stocks, MRPH, Chennai Petro, etc., these stocks had been a big underperformer for themselves. There was mild rally into these stocks, but then no major, recovery from the pandemic lows for themselves. But I think now this is the first month where you're seeing a decisive breakout. And we've seen that, as a pattern, that when you see such kind of strong moves, which happens in a limited duration of time, maybe a month or so, those tend to be more strong trend changing moves. So what was missing for these stocks over the last 1.5 to 2 years of the market recovery was this kind of a price performance where in just a matter of few months, these stocks can manage to break out of their yearly resistances and then start off to a trend where they are more sought after, whether it's in terms of short-term traders or whether it's in terms of long-term investors who tend to participate into these names. So what this move does is not just a price uptick and the breakout for the stocks, but it probably increases the level of participation from traders into these names. So that's the most important part, because when you see a stock getting into a sideways range with no kind of a price trend, it generally puts off the traders. And that's where we see lack of volumes, etc., coming by for such names. So this move which you're seeing for MRPL, Chennai Petro, etc., I believe should be a very strong trend-changing move, which could last for months and quarters on a trot. So specifically for MRPL, the stock closing at I think 68 or 69 levels for itself yesterday. I believe the stock could now be headed towards at least a level of 85 to 90 over the next 3 to 6 months. So from a short-term trading, I think it's much better to try and get into a buy on dip strategy, as well as more of position trading into stocks like MRPL, Chennai Petro, etc.
Okay, so let's call on some of the PSUs led by MRPL. Economic Times has today come out with a very big story, so let's address it. It's to do with the buzzing cement pack. We were just talking about the rally in the cement stocks we saw yesterday. Now, Holcim wants to exit India 17 years after it's been here in the operations via two listed twins, which is ACC as well as Ambuja. The big ET Economic Times story broken by our colleague Ajit Berman is that the Sajjan Jindal-led JSW Group, which already has interest in cement, is looking to buy out Holcim. In fact, it has dialed Carlyle, the private equity giant, the global private equity giant, to join forces to pick up Holcim's stake in both the listed twins, which, according to the Economic Times, after speaking to investment banking sources and industry experts, are saying the kind of bidding activity we're talking about from the JSW Group and Carlyle could be anywhere from $7 billion to topping $10 billion once the open offer is launched. And this, of course, being the interesting point that there are a handful of cement companies in India. The question is how many of them will succeed in finding a partner when it comes to private equity giants, joining forces and, of course, outbidding others. But Cement Pack certainly enthused in trade yesterday. We've already been talking about that, from a Shree Cement to an Ultratech Cement, and how everything has been changing from price hikes, the channel checks which are taking place. We already got you an editor's take also on this. Dipin Mehta, I know we asked you already about cement, but from the JSW Group perspective, and I'm sure till we know who will be the bidder once it's all official, a couple of stories will keep coming out, because there are only a bunch of cement companies, right, that can launch such a bid for the JSW Group. What could it mean if it were to bid, if it were to succeed, if it were not to succeed?
No, I think that in the listed space, it doesn't really impact the JSW Group companies which are listed. And I think this is more on the private side. So let's see how it actually plays out. And I think there'll be many interesting suitors for such a valuable asset. Even existing cement companies, larger ones, may be interested in tying up or doing it by themselves. And even a complete takeover by a private equity cannot be ruled out, because we are seeing that wherever there is such large deals taking place, private equity is playing a very critical role, where they acquire the company, they have the financial muscle power, and they rejig the management and try and get the company to perform much faster and far better. So that's something that cannot be ruled out. So let's just wait and watch, and let's see how this thing actually plays out before making any comment or taking any investment position based on this news flow.
So that was about the cement space, but wonder what's your view is regarding the FMCG and the consumption pack. Nestle, the big boy of the FMCG space, will obviously be reporting numbers today. The expectation is that the volume might take a hit on account of the inflation that we have seen, and that's the reason we might see a bit of downtick on the volumes. But on the flip side, CLSA came out with a note this morning on consumer durables, wherein they talk about that despite the run-up, the stocks are trading at a discount to their 5-year averages. How are you looking at the entire consumption and open up theme, etc.?
See, I think there are better choices available than the likes of Nestle, HUL, and some of the other FMCG companies, where growth has slowed down significantly, And a lot of the categories in the FMCG sector are mature categories where single-digit growth rates also is quite difficult. So if you want to play the consumption theme, then you have to move away from FMCG into some of the other more faster growing emerging sectors. Could be entertainment, the likes of PVR, could be travel like Indigo or Mahindra Holiday. It could be appliance companies, the likes of Voltas, Havells India, also come into play over there. Also, it could be building material, companies. So I think that overall the consumption spending patterns are changing, and Indians are moving up the value chain away from soaps, shampoos, detergents into maybe more entertainment. Or you could even add auto to that particular list. So I mean, there's a lot of choice as far as consumption is concerned. And the unlock trade, I think the question you asked over there, in our opinion, the best way to play it would be through retail. Companies like Trent, Aditya Birla Fashion, V-Mart, I think they're all showing exceptional growth rates. And what is even surprising is that the pandemic has had them look at their costs quite closely. So they're able to manage their costs far better, and therefore have a positive impact on their operating profit margins. And overall, that particular segment spending is looking up pretty well. And the upcoming festive season, marriage season could be the best ever for the retail sector. So I think that in the order of importance or best potential, you would rate retail, quick service restaurants. I think all of these to do far better than the likes of FMCG companies when it comes to consumption play.
Okay, Dipan, so that's the word coming in on the consumption basket. The pre-open rates are there for you on the screen. Nifty just around the flat line and the Sensex suggesting an uptick of around 0.3%. But these are just very, very initial rates coming in from the pre-open session. But, Kunal, I wanted to get your take. We've already discussed in detail what's happening in banking, what's happening with Reliance, consumption baskets, IT. So let me ask you about a smaller sector. Yesterday, we saw quite a bit of high delivery on Vinity Organics as well as Gujarat Alkalis and Chemicals. And today, Rallis India also comes out with numbers. Any stock that looks interesting from this pack?
So I think Vinity Organics is something which looks very attractive. I think that stock, in fact, I was discussing about this name yesterday on the closing segment as well, that how at one point of time when the markets were getting into a bit of an iffy zone in terms of trade, a lot of large cap names not being able to sustain the kind of rally as well as breakout. But Vinity Organics on one hand has been making a dash towards its all-time high levels. I think if I'm not wrong, the previous high for Vinity Organics was just around that 2,180, 184 level, and the stock had managed to cross those levels as well. More importantly, I think it's the setup for these stocks. So whether if these stocks get into a time-wise correction, spend almost 5-6 months in a tight range for themselves, a 10%, 15% kind of a band, and post that is when we see a breakout. That's a more stronger indication because these stocks have gone into a time correction. The indicators have mellowed down. The sentiments for the stocks manage to reignite when you see a breakout of this time correction for itself. So I think stocks like Vinity Organics, specifically looks very attractive. Maintain the stance which I discussed yesterday as well, that I believe that the stock could probably head towards even levels of 2,450, 2,500 over the very near term.
Those pre-open rates this morning, and it's a tentative start, but in the green nonetheless at 17,187 on the Nifty. The Sensex up in the green by about 162 points. What about mid-cap strategies from our chartists? And Naresh, what are you flagging off today?
So that would be a buy on DCB Bank. The stock first went through a big breakout very recently, double bottom breakout, made a quick move from 76, 77 levels all the way to 92, and now that day's move is being faded off. The low on that day was around 78, 80. Yesterday we came very close to that 80 mark. A good opportunity to get back in at these prices with a stop loss at 77, and the next move I would expect it to go to 100.
Okay, meantime, Kunal, have you run us through your top mid-cap idea?
So it's not specifically a mid-cap name, but Bajaj Auto is something which I would want to highlight as an interesting buy. My sense is that the auto stocks are getting into a very strong breakout zone for themselves. You look at Bajaj Auto, the last 1.5 odd month, the stock has recovered 20% plus from its previous lows. 3100 was the previous low for Bajaj Auto. The stock had recovered 20%. Then it went through a correction in the last few trading sessions, more or less in line with the overall market, and now it's making a dash back again. So stock taking support of this 200 moving average. Very strong uptrend, very shallow recovery or correction for the stock price. That indicates that the strength is still intact. Would expect the stock to hit back towards its previous swing high, 3820 as a target, stop loss 3655.
Today from our charters, but let's just revisit the top story today we saw in Economic Times. It's a big one. Over the long weekend, Holcim, of course, announcing that and making it official that it is looking at the possibility of exiting India. It's been here for 17 years. The two cement twins that are listed, ACC and Ambuja. JSW Group looking to join forces with the Carlyle Group, private equity global giant. You could be looking at anything between 7 to $10 billion. We've now been joined by Rakesh Arora to talk more about this big story. Rakesh, I remember having you on the channel earlier this week, and we were just discussing among ourselves at that time that there's just a handful of companies that we thought on Monday that would be looking at bidding, and I'm sure in the days to come we'll be hearing of more names. What did you make of this one, JSW joining forces with Carlyle?
Well, see, this is no surprise because as we discussed earlier, that this is once in lifetime kind of opportunity. It's a great asset, and a lot of business houses in India would be trying to acquire it. The paycheck is around $10 billion plus, so that's why they are trying to team up with private equity players to fund this acquisition. So I think we'll hear more such news in the next few days, where other business houses also come out with some kind of collaboration with other private equity. So I think things are progressing pretty well on that front.
To talk about Holcim's business, that cement group is the second largest in India, commanding about an 11% market share. But it has been over the years losing market share. So I think the markets have accepted what kind of an asset it would be to have these two twins in the portfolio. But your guesses on who could be the other bidders if the Sajjan Jindal Group, which is not one of the larger cement groups in the country, is looking at it to gain market share? What about an Ultratech? What about the others?
So, see, the business houses which have shown interest of getting into cement business, obviously JSW Cement is already a known name, and they have a decent size already in India. So for them, it is a natural extension. Then Adani Group has also, shown interest. They have formed a division called Adani Cement, and they have bid and acquired a few limestone reserves. So Adani is also probably in the fray. Then obviously the incumbents, which is Ultratech, Dalmia, and Shree, these are the top three who I think should be bidding because it makes logical sense for them not to allow any other, strong player come into their sector. So I think they should also be aggressively bidding. So all these 4-5 names are going to be the front runners.
So let's watch out for that. The market's certainly expecting from Ultratech, the Adani Group as well, Dalmia Bharat, which has been gaining market share. And I remember the top boss, Puneet Dalmia, telling our managing editor Nikunj in an interview about how we're likely to see a few players gain market share at the cost of the smaller ones. Interesting times. This is the next big M&A to watch out for. Thanks, Rakesh, for joining us. And Deepan Mehta, I know you have to go. It's always a pleasure talking to you. Thanks so much for joining us. He's got a wait and watch strategy at the moment. It was great, as always, to get his views on from IT to financials as well as cement. Ladies and gentlemen, we're going to be taking a short commercial break. Stay tuned. We'll be back in less than 2 minutes.
A vision becomes a milestone when it helps make a cleaner, smarter, and a more beautiful planet. So that you can set off on joyous new journeys and adventures. Building stronger bonds and bridging impossible distances. which take you from the ever new to the forever beautiful. Opening up vistas and windows to a vibrant new world. A vision becomes a milestone when it touches millions of lives. Aditya Birla Group. Big in your life.
Right, welcome back. We got a couple of minutes to go before the for the first trade. Before we do that, I thought, Kunal, let's talk a little bit about the bank Nifty, right? We've all been watching out for that, as we always do every day, but we're waiting for the next up move. It just seems so far away. Yesterday, you even saw ICICI Bank trade in the red.
Well, yes, Nantara. So I think that's a bit of a dichotomy for the banking stocks. There is no synchronized participation for the banking names. So, we can take examples of so many of the other sectors like cement, like autos, etc., where there is a synchronized price action that leads to a very strong set of confidence from traders to participate. But, in the last 2 weeks as well, we've seen different moves for the banking names. On one hand, Hdfc Bank was one of the major stocks which went into a sharp sell-off mode. That led to the bank Nifty also get into a correction. But I think in the last few days, you had some resilience coming out from ICICI Bank, etc. So except for a day like yesterday, where ICICI Bank actually underperformed, HDFC Bank showed some mild uptick for itself. But it's very scattered and very diverse in terms of signals. There is no synchronized price action that you see. Many of the large cap names tend to participate on the same direction at any point of time. So till the time we see those scattered signs, we may not get into a strong reversal mode or an uptrend mode in the banking stocks. I believe that if we start to see those signals where the likes of Kotak Bank, Axis, Indus, ICICI, HDFC Bank, if they start to get into a strong uptrend mode, the bank Nifty can get into a much more stronger recovery. So we'll have to take it step by step, maybe keep a watch on how the internals shape up, and then take a call on the broader call on the bank Nifty. But as of now, I believe looking at the short covering, looking at the status of the markets, and possibly some revival into the many of the other sectors, even bank Nifty can get into a slight revival mode. So 37,000, 37,200 could be a very immediate target for the bank Nifty, which I'm expecting over the next few trading sessions.
Naresh, we've been talking about Apollo and the price up move that we've seen, right? But yesterday, if you just see the deliveries on Max Healthcare as well, what's exactly going on in the hospital space?
So, if you look at Max Healthcare, there was a bull deal also a month back roughly. That is where a lot of selling got over. It was a huge bull deal, almost a crore shares. So now finally the stock has broken out after consolidating for almost a month or more. So technically we are seeing that selective healthcare stocks are doing well. And others have been doing well slowly and steadily. So if you look at Max Healthcare also, over the last, say, 1.5 years, the stock has gone from 100, 150 to 400. But it's not been a stock which goes up 15, 20% on a single day. So it's been slow and steady move. Same with Narayana Rudale and Healthcare Global, etc. So it's a secular trend across the board. Something like a Fortis is an underperformer. But it's a slow and steady trend. So out here, would be looking out for a buy on dips rather than jumping on the breakouts.
Get those index calls going as well. We do remember that we're holding out close to the 17,200 mark on the pre-open rates. What are our chartists advising this morning? Well, let's take a look as to what the outlook is on the index. Do remember, by and large, the consensus call on the index has been a hold recommendation. But today, it's a buy call coming in. Kunal, Naresh, as well as Santosh advocating a buy. C. Rudramurthy, well, he's not moving from his stance. It's a sell on the Nifty. So that's the moodometer this morning. Ahead of the market open, it's a thumbs up when it comes to the index. A clear buy call, that's what our chartists are advising. What about the Nifty Bank Index? Because that's been at a bit of a stumbling block, if you will. You did see some amount of recovery kicking in, although it wasn't all that convincing. But the Nifty Bank consensus still, most of our chartists are advocating that at the current levels, it's a buy recommendation. There you have it. Kunal, Naresh and Santosh saying that it's a buy call. C.A. Rudramurthy, sell recommendation on the Nifty Bank.
rebound that we saw in the markets yesterday seems to be holding out today as well, because the Nifty has started in the green around that 17,200 mark. The Nifty Bank has also surged almost 0.5% to start off the trading session above the 36,500 mark. There were mixed cues coming in from the globe, but if you look at the Nifty, that one has managed to hold it comfortably in the green. Let's start with the heavyweight Reliance actually, because that stock is likely to hit the record high levels. Remember, 2750 is the highest level on that counter. It's already surged 1% today and very close to hitting that life high on Reliance. So we'll watch out for that. In fact, other oil marketing companies like BPCL and IOC, etc., were also likely to open up in the green. Hdfc Twins is something that we are watching out for. We have seen quite a bit of underperformance of late, but given the fact that ICICI Bank has taken leadership in terms of trading at a premium versus HDFC Bank, will keep all of these stocks on our radar. Cement is one pack which was buzzing yesterday. We continue to track it today as well. Wholesome is looking at exiting its stake in the likes of ACC and Ambuja, and it's having a ripple effect across the sector. The likes of Ultratech Cement, Shree Cement, JSW Group, they're all in focus on account of this particular news. HCL Tech will be reporting its numbers today. The expectation is it is going to be a muted set. Let's see how the stock is going into its numbers. It's holding up in the green with an uptick of around 0.6%. We have also Tata Elxsi, which will be reacting to its numbers from the broader markets. The quarter-on-quarter growth was decent at around 8%, but the stock trades at very expensive valuations, still holding up above the 8100 mark on that counter. Nestle is the other heavyweight which will be reporting its numbers. The expectation is there will be a volume degrowth on account of the inflation. So that's the counter we are watching out for. From the broader markets, we're also watching out for MRPL and BPCL. Given the fact that fuel demand is at a 3-year high, GRMs have been quite escalated. That stock has been running up already, and today as well it's opening up with a thumbs up of around 6%. Angel One reported its numbers wherein the profit has doubled on a year-on-year basis, so that stock is likely to see a positive reaction, 7% higher on that. Nykaa has done a tie-up to open some of the salons with Aveda Group, so we are watching out for that counter. ICICI Securities on the flip side reported a weak set of numbers, and that's why that stock was reacting negatively. We also have Gland Pharma on our radar, wherein 1.5% stake was to exchange hands, and that was going to happen at a discount, so we are seeing that reaction on that counter. Vinati Organics was the other stock that was buzzing yesterday. What is it today doing? Let's look at that as well. Up around 1.5%, and other than that, some of the pharma names like Apollo Hospitals as well as Dr. Reddy's is something which is doing well, up opening with a gain of around 1.5%. Overall, the advance decline ratio is firmly in favor of advances, with 1,553 stocks advancing to 179 stocks declining. So looks like broader market is definitely doing the party today as well. Back to you guys in studio.
Okay, so that's the market set up for you. It's just a few minutes after the opening bell. Let's go across to Pankaj Tibrewal, the Senior Vice President and Fund Manager at Kotak Mutual Fund. A long India bull who at the start of the year was saying this is India's decade. This is the year we're going to see a lot of uptick in manufacturing. He was bullish on the capex cycle being played best with banks and, of course, manufacturing textiles. Pankaj, good morning. The first question I have to ask you is, we're talking in a morning where we got news that Bill Ackman has lost nearly $500 million in just a few months on his Netflix investment. Look at the volatility globally. Nobody's able to make sense of it. Back home, look what's happening with the blue chips. Nikunj Dalmia is calling it the blue chip fatigue. If there's going to be a fatigue for large caps and blue chips, what are you supposed to tell your clients? What are you telling your clients?
Yeah, good morning. If you remember at the start of the year, we said that this year will be a year of consolidation with heightened volatility. And we should be focusing this year more on capital preservation. Though the medium-term outlook for India looks extremely positive, but this year needs to be navigated carefully. I think a few of the concerns which we are having, first, I think for the next few quarters, we would see limited earning support because we are seeing margin compression across the board. And don't forget, from September 2020, the rally which we saw was supported very strongly by earnings growth, not only in India, globally. But incrementally, we believe that that pace of earnings upgrade will slow down. And in some sectors, we are staring at an earnings downgrade cycle to start, led by elevated commodity prices. Second, I think interest rates across the globe have started rising, and central bankers are running behind the curve. Inflation is, 3-decade, 4-decade high in many of the countries. And our worry is that the central bankers may overreach in terms of interest rate hikes as well as quantitative tightening. The third one is that elevated commodity prices increases the odds of a global shock. And when you combine these things along with the FI selling, I think this year will be range bound, consolidating, and the focus should be bottom-up stock picking. And that's been our communication to our clients as well, that treat this year as a consolidation year rather than making money going in 2022. Also, don't forget that in US, there's a very strong correlation with rising interest rates and underperformance of tech. And we have seen there the 10-year benchmark almost touching 3%. And the way NASDAQ has reacted, it's down almost 15% calendar year to date, and many stocks are down between 40 to 60%. So clearly we are seeing that, pressure being built in on the tech stocks there. As interest rates rise, it will act as gravity on very high valuation stocks. And we are not very surprised by this move.
But Pankaj, I know we're not supposed to look very short term, but is this a mood change that we are seeing now when it comes to a bunch of large cap stocks? And these are the ones that are, credited for taking the markets higher. Infosys, Hdfc Group. For the first time, you now even have ICICI commanding a premium against Hdfc.
So yeah, a part of that could be because of the technical reasons on the FI selling. We have seen unprecedented selling by FIs over the last 6 months. More than $20 billion have been sold by FI, and domestics have been a big support to the market. I think a large part of the holding of FI are in the names you just spoke about, or the blue chip names. And obviously, when the ETF selling or the FI selling happens, it mostly is reflected in the index. But one data point which I would like to share with you, that somewhere on a rolling basis, the FI selling as a percentage of GDP is almost coming close to 1%. We have seen in the past that whenever that number of one quarter hits it, either the FI selling slows down or there is a reversal in terms of FI becoming buyers. I don't know what will lead to that, but there's a high probability that as we move ahead, the valuations will protect FI from selling more of these blue chip names. As a house, I think we are seeing value in many of the blue chip names. And our house call is that we should start going slightly overweight on large caps. And we believe that over a period of time, these large caps will offer value, and they are offering good growth as we move ahead. And they have the balance sheet to withhold the volatility. So I think a good time over the next 6 months to deploy your capital gradually over some of the blue chip and the large cap names.
Hi there, good morning. I wanted to understand what the outlook is after having read into the kind of quarterly numbers declared by the IT companies. The street clearly gave it a huge thumbs down, and we saw even the overall valuation picture getting quite challenged when it came to the mid and the small and the large cap IT names. How are you reading into the overall valuation picture, the growth challenges, attrition rates, etc., when it comes to IT? And do you think that after this quarter, perhaps we can see some amount of stability kicking in when it comes to earnings?
Yeah, so what we have been saying over the last 6 months is that a large part of return in IT companies have been because of PE re-rating. Yes, they delivered on earnings growth, but if you plot the total returns delivered and segregate it between earnings growth and PE expansion, a large part could be contributed because of PE expansion. And the first reflection came post the third quarter results, when the companies reported very strong results, but the stock reacted negatively. And that was the first indication that we could either see some time correction, which could lead to PE adjustment, or absolute PE de-rating. And I think we are seeing PE de-rating happening now. I think market had factored in a lot of growth. And what came as a surprise is the attrition rates in some of the names which have been reported. Large caps are seeing 26 to 28% attrition, which they have never seen almost in last 10, 15 years. And that's leading to some kind of margin pressure. So the demand momentum remains strong. The commentary and the pipeline of deal flow has been extremely good. But margin pressure is something market is trying to readjust. And our sense is that next 6 to 12 months, we could see earnings growth coming in, but there could be some kind of PE rating, which can happen, and markets may readjust the PE multiple as you go ahead. So that's why we have been a little careful and cautious, especially on the mid-cap IT names, where we believe that there could be some reset to the PE multiples as we move ahead.
Request you to just stay on with us because we have our flagship event, the India Economic Conclave, that is due to begin in just an hour or so from now. And my colleagues are at the venue, the NCPA in Mumbai, and we're getting a bit of a mood check as to what we can expect and if whether or not people have started filtering in. Utkarsh Chaturvedi, Ankur Sharma, my colleagues join in to give us a heads up as to what we can expect on day one.
Well, when it's about the best of the best, it's about the India Economic Conclave, and you can see here that lines have started queuing up because in minutes from now, the biggest economic conclave not in the country, but globally, will start up. Ankur, how's the mood looking like? You know, as I said, everybody from corporate, policy making, government, everybody is here.
The biggest testimony is that, as you can see behind me, the economic conclave is still few minutes away, but the line is long. Means everybody wants to watch, everybody wants to see what is happening here. And if you talk about the agenda, see, we have a diverse agenda here. It's not just that economic faces will be there, the bankers will be there, but you have politicians, you have ministers, and you have actors too, because everybody contributes to economy.
The dialogue which is going to happen, and you know, we keep speaking about the fact that India is at an inflection point. What direction will the country go from here? Will be spoken about, talked about, and decided from this conclave and from this stage, which is almost set. Within a few minutes from now, we'll see the guest coming in. So you keep watching ET now because you don't want to miss even a second of that.
Okay, so that was about the biggest event that we have as far as the India Economic Conclave is concerned. But let's take a quick look at the markets in terms of which are the key stocks that are buzzing at this point of time. On the gaining side, we do have names like Coal India, which is doing well from the frontline index. IndusInd Bank has come out with a gain of around 2%. We already talked about Reliance, which is surged at 1.6%. Let's pull up the counter of Reliance. I think it's already past its life high level of 2750. It's making a fresh record high on Reliance and a gain of 1.7%. On that. It has already piled gains of around 7 to 8% over the last 2-3 days. So that stocks definitely needs to be on your radar. From the broader market, we are looking at names like Angel Broking, which has surged 9%. We have AI Engineering, which has gained 5%. Cyient and Tata Tele, which are reporting numbers today, are going strong into the numbers because those two counters are up around 5%. On the flip side, Nestle is expected to report a moderate kind of number this quarter, and that's why perhaps we are seeing a bit of reaction on that counter. A bit of red tick is what I remember seeing on Nestle. Separately, a red tick coming in on ICICI Securities as well, which has slipped by around 5% on account of the weak showing coming in from the numbers. Pankaj, hi, good morning. This is Anisha joining into the conversation as well. We have been talking about the entire buzz in the cement pack on account of the news regarding Wholesome looking at exiting its stake in ACC as well as Ambuja, and that could mean a big, acquisition coming in, an important one at that for rest of the players. What do you make of this particular event, and how are you looking at the cement pack, given there is a very, evenly balanced amount of headwinds as well as tailwinds that the sector is facing?
So on the cement side, let's break the discussion into two parts. One, let's talk about the sector and our view. And second, the buzz or the rumor of the deal going through or not going through, we'll spend some time there. On the first part, on the cement side, I think we are positive on the sector as a whole. And we believe that when you look at from a slightly medium-term perspective of next 2 to 3 years, the supply side is constrained. There are not too many capacities which are coming on the cement side. And we believe that the demand would at least move between 5 to 7%, basically led by real estate and infrastructure. And I think if that's the case, the pricing will be quite strong. Barring the near-term volatility where raw material prices have gone through the roof, coal prices are in excess of $300, and that's putting pressure on the margins of the cement company. So barring the near term, I think the structure of the industry is quite good. Consolidation has played out quite nicely over the last 5-6 years, and there doesn't seem to be too much of supply coming into the sector. So that's giving us a positive outlook from a medium to long term. Now look at the talks about or the rumors about large group exiting India on the cement side. I think the way I look at it is from a positive perspective. Think about it, about 12 to 14% of India's capacity will change hands. Earlier, the group was, had set up the plant at say 2,000, 3,000 rupees per ton. Anybody who buys it will buy in excess of say 10,000 to 15,000 rupees per ton. And person who invests such large pool of capital will look to buy or look for returns, at least 10 to 15% return on capital. And that means a lot of pricing discipline would be there in the industry, whoever, plans to buy 12 to 14% of India's capacity. So I think it will bring a lot of discipline, the way I look at it. But we are not, we don't know whether any such deals are happening. We are just reading the same media reports which you are reading. But in case such deal happens, it will be positive from a pricing discipline perspective, because 12 to 14% of India's capacity would change hands at a higher price. And I presume the buyer would think about return on capital, 10 to 15% on that capital invested over longer periods of time. And that will bring a lot of discipline in the industry.
Okay, that's an interesting take regarding the entire cement pack, as well as what to make of the reports that all of us are reading regarding one of the large players exiting the Indian markets. But Pankaj, if you look at the markets today, the top two gainers are the underlying commodity plays, Coal India as well as Reliance Industries, which has hit a fresh high today at 27.64. And you were talking about, earlier in your first answer that there is some of the sectors which are likely to see upgrades while others might see downgrades. Is commodity one sector which still has some steam left to move on the upside? And specifically, if you can talk about Reliance in terms of the GRM moves that we are talking about, which is at a record high level, what do you make of this sector?
So we can't talk on stock specific, but our sense is that commodity prices are very highly elevated, and that's increasing the risk of a global shock in our view. Look at this way, the global GDP is roughly about $100 trillion. The oil market today is about $4.5 trillion, which is 4.5% of global GDP. Add to that natural gas, add to that metals, and add to that food, the soft commodities. You're talking about the contribution of all these now in excess of 15%, which is more than 15 trillion to the global GDP. Don't forget that any incremental change, which means that the incremental surplus is moving to the producers and somebody has to pay the bill, either the government or the consumers. So that surplus is getting lowered and moving to the producer surplus. My sense is that there are supply side issues on the crude side. No incremental new discoveries have come in over the last 3-4 years. No new capacities on steel, aluminum, copper have large capacities have come in. And as a result, there's an intermediate demand supply mismatch, which is leading to elevated prices. But at some point of time, from a medium-term perspective, these elevated commodity prices will lead to inevitably a demand destruction. And that will bring down the commodity prices lower. Maybe it may be higher than the last 5 years average, but such high commodity prices may not be sustainable in our view over longer periods of time. So I think in the short term, yes, the odds are that prices may remain elevated because of geopolitical and supply side issues. But from a medium to long term perspective, they need to revert back to mean. Otherwise, there will be demand issues globally. And we are already seeing early signs of that.
Pankaj, hi there. I also wanted to understand your outlook when it comes to the entire consumption basket. With the inflationary raw material prices going higher, the expectations are that volume growth will be dampened. Companies have undertaken price hikes in order to mitigate the impact of the same. Do you believe that one needs to be very selective when it comes to the entire consumption space, also with looking at commanding valuations?
Absolutely. I think in the near term, we may see margin and volume pressures both on many of the consumer names. And our channel checks suggest that companies are not able to pass on the entire price increase to the consumer. So I think over the next couple of quarters, we should see earnings downgrade in this sector, especially in some of the consumer discretionary names, some of the consumer staples names. But that will provide us an opportunity to buy into some high quality franchises at decent valuations. So I think clearly over the last 12 to 18 months, if you look at the consumer staple basket has underperformed quite substantially to the overall market. And I think that could be the case for the next few quarters as well. But that, whenever we get an opportunity to buy at decent valuation some of the great dominant franchises, we won't shy away. Actually, we are looking at such kind of correction to dip into because the medium to long-term story on consumption remains robust. Yes, there are near-term headwinds, and we will look to use those headwinds to increase our exposure to that sector.
You know, auto presents a lot of opportunity, particularly when it comes to the EV space. We understand that, India is expected to become the third largest market for electric vehicles by 2025. But there are a lot of challenges as well being presented on the same in terms of, a very high cumulative investment and, the EV charging stations as well, which require a high price. How are you looking at, the stage being set for EVs and what the challenges are when it comes to the automobile industry fulfilling this ambitious challenge?
So I think India is going through a massive transition from ICE engine to EV. And I think globally that's happening. And our sense is that most of the global manufacturers, as well as Indian manufacturers, will look to transit from ICE to EV. Now, what is not established is whether the ecosystem will be more hybrid or it will transit completely towards EV. Because don't forget that on the EV side, battery is very, very important, the lithium-ion battery. And India doesn't have too much of reserves on the natural resource on lithium. So finally, we would be dependent on China for our raw material purchase. So whether green hydrogen is the right way, hydrogen is the right way, or EV through lithium-ion batteries is the right way, only time will suggest. But there's a massive transition in the auto industry which is happening. And we need to be navigating this transition very carefully. There could be many companies which will destruct values. There will be many companies which will create enormous value, which we have seen globally as well. And we need to really pick and choose the right company in this sector. Otherwise, over the last 3-4 years, we have seen that many of the companies have not created the wealth they ideally should have, and we should not be in a value trap. So we are very carefully evaluating this space and keeping our heads down and doing channel checks, looking at the ground, what are the changes happening, and then probably taking a call. But yes, for sure, there is a transition happening in the entire auto ecosystem as we speak in the country.
But I wanted to pick your brains regarding two smaller sectors, that is defense as well as power. Now, we are talking about order inflows coming in for the defense sector, but do you think it is the right time to make it as a serious investment going forward? And power has been one space which has been a laggard. People have been talking about growth versus value when it comes to the power sector as well. What's your take regarding where power sector is headed?
So two very good questions. I think the first one is on the defense and capital goods. And we have been advocates of revival in manufacturing and investment cycle for almost more than a year now. And we are seeing more and more evidence emerging, which is supporting our thought process that finally, after a long time, manufacturing is seeing uptick in India. And that's led by 2-3 things. One, the entire PLI scheme has started to gain traction. And sector after sectors, we are seeing that companies have been allotted licenses. They are investing in factory and buildings, and probably next 2-3 years could be very strong in terms of sales. The second is the China Plus strategy. Companies may not be coming out and talking about it openly, but sector after sector, when we are evaluating the export data, we are seeing strong momentum. And this year we have crossed, which was FY22, more than $400 billion in export. And engineering exports has crossed more than $100 billion. That's a very substantial number. So I think the China Plus, it's playing out its role very silently, and companies after companies are seeing orders being diverted from China to India. The third part is obviously India becoming more Atmanirbhar, and defense is playing a major role. Countries have realized the need to spend on defense after the geopolitical tensions, what we are seeing between Russia and Ukraine. And Germany came out with their statement. China, we have seen the defense spends being higher than the GDP growth. And similarly in India, we are realizing that we need to be more Atmanirbhar and have more indigenous production rather than depending on imports. And I think that's a very sunrise and a very strong sector, though we need to factor in that the orders will take time to actually materialize and become a part of your order book. But never said that, companies are extremely bullish, whether it is in private sector or PSU, and we are seeing strong demand traction. And many of the companies are part of our portfolio on the defense theme. So as a theme, we like capital goods and defense, and we believe that there's strong momentum building in from a next couple of years perspective on this theme. On the power side, I think, as I said and explained about cement, I think on the power side, on the thermal, we haven't seen any new big capacities being installed over the last 3-4 years due to ESG and various other concerns. I think in the near term, the power prices may remain firm as we see strong demand into the summer season. But over a period of time, I think renewals will catch up, and probably that should provide incremental capacity to meet the demand. So yes, near-term power stocks may do well, and power sector may do well because of the firm demand on the power side.
So that's the word coming in on the defense as well as the power space, but we will let you go on that note. Appreciate your time and joining us with your insights on the sectoral bets that you're looking at this point of time. Well, let's move on and talk about earnings now, because we're in the thick of the earnings season. We got numbers from Tata Elxsi yesterday. It did report a good set of numbers with the constant currency growth coming in at 8%. Margins did contract by 70 basis points, but despite that, the company has maintained the margins at over 30%. The stock is reacting positively, up around 0.8%, but the stock trades at very high valuation as well, 60-70 times the forward earnings, and that is why we are seeing a tepid reaction. We're now joined by the management of the company. Mr. Manoj Raghavan, CEO and Managing Director at Tata Elxsi, joins us on the show now. Good afternoon, good morning, sir. Thank you so much for joining us, Mr. Raghavan. First up, let me ask you about the demand environment itself. Your FY22 revenue growth was a solid 34%. Is this kind of growth rate sustainable, and what is your assessment of the demand at this point of time versus what you saw 12 months ago?
Good morning, and good morning to your viewers. Yeah, we've had a pretty good, financial year. We ended the financial year upwards of 35% growth in revenues, and more importantly, a consistent quarter-on-quarter growth, right, between 7 to 8%, right from Q1 up to Q4, right? At this point in time, I see no reason why, I mean, the demand is pretty strong. I don't see any reason why, we should be worried about it. We continue to be very bullish, and as long as we execute on our strategies, I believe we are on a good wicket, to show consistent growth.
Demand environment, because this quarter the growth was led by the European region, which grew almost 10% quarter on quarter. Now with the inflationary pressure and the entire geopolitical tension, are you seeing any impact on the client spend and the budget, given the fact that we are seeing inflation across the globe being at decadal high levels?
We really don't see any effect of the geopolitical situation. I mean, we don't have any customers or any business in the Eastern European region and Russia, right? So to that extent, we really don't don't see a cause for worry or anything. But the good thing about Tata Elxsi is we are, if you look at our regional split, we are, split between the US, Europe, and the rest of the world. Similarly, from industry vertical also, we're well diversified, among three different industry verticals. So we sort of, I would say, de-risked our entire both business portfolio as well as our geographical mix. So to that extent, I think, even if there are some issues in a particular region or a particular industry vertical, I'm pretty confident that we'll be able to manage that because of exposure to other regions and other verticals.
Good morning, Mr. Raghavan. I'm just going to digress a little bit from your earnings. This is Nayantara Rai, and I wanted to start my interview with you asking you one question, which is, and I'm sure our viewers would like to know, what does the MD and CEO of Tata Elxsi think when he sees the share price? Because the share price, the way it has been moving, the way we've been talking about it this year, it was flirting with 9,000 rupees. Just look at the way it's up year to date. What do you make of that? Reflection of the earnings we're seeing today, or what is it?
No, I don't really, understand this market and, why the share price is where it is and so on, right? What we are focused is, ensuring that, we deliver consistent results, right? So I would say, whatever you're seeing, whether the results, the price going up so high, I would say is a result of the, consistent performance quarter on quarter. And at the same time, we are engaging with the various stakeholders, our investors, a lot more, disclosures, a lot more, having those conversations on a regular basis. All of this, I would suggest, gives confidence to our investors that, they are in safe hands.
Okay. So coming back then to the quarterly report card that has been put out, back to the business performance as well. Earlier you did say that, you're going to be seeing a growth in the automotive market. Is there any change on that front, just given the way the automotive market is performing, the slowdown that you see from everything from commodity inflation to whether it is, supply solution? Will that have a trickling down effect on Tata Elxsi, and what your plans were?
Automotive industry, I think last financial year we did have a dip in the growth and so on, but this financial year, I think the growth has come back, and you would have, if you'd seen a performance over the last 3 quarters, it has been primarily led by the automotive, vertical. We continue to clock, new deals. We continue to, grow our existing accounts, deeper mining of our existing accounts. Our existing large customers are very bullish about their business. And a lot more, projects coming our way. So I'm not really worried about, if the automotive industry is going to, go down or so. So at least I would say next 2 to 3 quarters, I don't see any of that affecting us.
Your take regarding the profitability and the margin picture. You've ended Q4 with an EBITDA margin profile of 32.5%. What should we expect for the entire year FY23, given the fact that there is this wage inflation impact which is likely to come into the IT companies' earnings as well?
Yeah, we don't usually give these projections, right? But at the same time, let me tell you that for a majority of our workforce, that is a junior workforce, we've already done the wage hike in January. So the numbers that you see today are after the wage hike.
And talk to us about the embedded product design as well, because that forms bulk of your portfolio. It's reported robust growth quarter on quarter despite a heavy base. Is this growth rate also likely to continue? What are the key trends that you are seeing in this particular service space?
Yeah, the embedded product design business is like the main business of Tata Elxsi, right? And the growth over the last 2 to 3 years that we have seen in the organization is primarily because of the consistent growth in the embedded product design business. Again, we focus on 3 verticals, the transportation business, the media and communication business, and the healthcare vertical. So what we look at it is over a period of 3 years, the business mix would be about 40-40-20, and that's where we are moving towards. Healthcare and medical has been the smallest business for us, but it has been growing very rapidly. I think the last financial year, we grew almost 70%, I think 66 or 67% over the previous year, right? So that will continue to lead our growth. As we discussed, automotive, business, I don't see a slowdown happening, and I'm pretty bullish there also. Media and communication has been a very steady business for us. clocking very good returns quarter on quarter. So I think EPD overall will continue to lead the growth for Tata Elxsi.
What about attrition, Mr. Raghavan? We touched upon it very briefly. It's come in at almost 21%. I know the industry at large is grappling with attrition. You even have Elon Musk once taking to Twitter talking about engineers. But what's the game plan? And how is this going to continue to eat into the balance sheet?
Yeah, attrition is a concern. I mean, any IT leader, right? That is a prime, sort of concern for him, on a day-to-day basis, right? So we track, attrition very closely. Yes, attrition has shot up to, slightly about 20%. But I think as compared to a lot of our competition and the larger industry, I think we are still in a better place. I would say. I wouldn't say much better place, but definitely a better place. We are doing a number of steps. We talked about, the wage hikes. There are a number of other things that we're doing, including, learning and development opportunity, leadership development, opportunities for our resources. So there are a number of things that we are doing internally to ensure that, employees who work with us, continue to work with us. The challenge for us, has been during this pandemic time. I mean, when majority of our employees have been working from home, so we see that a lot of our employees, if you analyze the attrition that is happening, I would say about 50-60% of the people who are leaving us have joined us in the last 6 or 12 months. So there are people who have joined us virtually and has left us virtually. So that is a main challenge that we are facing. So a lot of infant attrition, so to say, right? But however, many of the long-termers are definitely, continuing with us, and the attrition, at least among the key employees and the long-term employees, that is, much, much smaller than, the reported attrition. So to that extent, I would say, attrition is under control. However, we really are, on a day-to-day basis watching it and, taking steps to ensure that, we don't get into a bigger mess.
What about the deal pipeline? What is that looking like?
We have the deal pipeline. The demand situation has never been stronger, over the many quarters, right? So I have absolutely no concerns on that front. The sales engine is rocking. We've ramped up our sales engine, over the last 4 quarters, and that's really delivering, results for us. The challenge for us would be to ensure that, we service all the requirements that are coming our way, with the attrition and with the hiring situation, right? So that, if you ask me, demand is not an issue. Supply is definitely an issue, and we need to figure out ways to address that.
We'll let you go on that note. Thank you so much for joining us. So demand is definitely not the problem. It is the supply side issues that need to be watched out for. That's the word coming in from the top brass at Tata Elxsi. But let's move on and take a look at the markets as well, because the Nifty is close to the highest point of the trading session, above the 17,250 mark. What are the key internals? What are the important levels to track? Which are the sectors which are outpacing the others? Jayesh is standing by to tell us all of that. Hi, Jayesh, take it away.
Hi, Anisha. Good morning. So this is exactly what the FIs had braced for themselves. As of yesterday's closing session, they had built in long positions into the market by way of put writing at lower levels. And that is why we are seeing some bit of bullish undertone for the Nifty as well as the Nifty Bank. Interestingly, what happened at the open was that we did manage to, open above the previous day's high point for both the Nifty as well as the Nifty Bank. And most importantly, for the first hour of trade, we have held on to those levels. So, in case towards the end of the session, we are still at current levels, there could be another round of short covering that can be expected from the markets, given that, it is the weekly options expiry as well. So both the Nifty as well as the Nifty Bank trading with, gains of more than 0.5%. And for the Nifty Bank, more importantly, surpassing its 200-day moving average. What's been adding to this particular rally is the fact that the India VIX is cooling off. It is in fact trading with identical open and high levels. So exactly from the open, there has been some bit of downward pressure for the India VIX index. There has been good contribution that we have seen from the broader market space. Both the Nifty small and the mid cap index have been outperforming. However, it is interesting to note that last couple of days during the first half of the trading session, this has been the trend. But as we move towards the closing hour, both the small and the mid cap index tend to give up gains. So, it will be interesting to see how today pans out. One sector that has been in focus today is the Nifty Metal Index on the lower side. Now, this is primarily, given the fact that the dollar index has inched towards the 100-101 mark. So we are seeing some bit of weakness for the metal stocks, and that will clearly show you, how the Nifty gainers and losers are actually pointing out. On the losing end, you will have a lot of metal counters as well as Nestle, which is amongst the worst 5 performers ahead of its results.
Thank you, Jayesh, for joining us with those insights on what's happening with the market at this point of time. But it's time now to get some sage advice from the wise men. And we here on ET Now have been speaking to a whole host of experts to get you the details in terms of which are the sectors that you should be betting on. What are the wise men talking about? My colleague Somit has compiled that list. Let's go across to him. Hi, Somit.
We'll start with Ridham Desai firstly, and he's bullish on financials on the back of higher credit growth. He's also bullish on consumer discretionary because he's expecting strong growth from this sector. On industrials, he's bullish because of the government capital expenditure, and on tech space, he's bullish because he believes that this sector is least exposed to domestic growth. When it comes to underweight, he's underweight on consumer staples owing to the margin pressure. He's underweight also on utilities because of the sharp run-up that we have seen recently, and he's underweight on healthcare, energy and materials. Secondly, we'll see from Manishi now. He's very positive on the consumer space, and he's focusing on market leader and distribution leaders in niche category. He's also bullish on oil explorers, but not so bullish on the oil marketing companies. On IT services, he's bullish from long-term perspective. Also from media sector, he says that there could be some pressure for the next couple of quarters, but from long-term perspectives, the media space is expected to outperform. On banks, he's more bullish on the private sector banks. Also, he's cautious on the auto sector. Lastly, coming in from Aditya Naren, now he believes that the IT could be soft in the near term, but from long-term perspective is bullish because he believes that the demand trend is expected to remain strong. On financials, he's expecting some kind of demand pickup, which will be captured well by large cap banks. That is what he believes, and he's saying that he will buy both HDFC and HDFC Bank post the recent correction.
Thank you so much for joining us with that detail in terms of what the wise men are talking about. But let's take a look at the markets itself, and let's take a look at Reliance, because that stock continues to surge. In fact, it's now sitting with a gain of around 1.5%. The stock has hit a life high level of 2760 thereabouts. If I remember it correctly, the earlier high was near the 2750 mark. So quite a bit of up move is what we have seen on the counter. And Morgan Stanley also came out with a note this morning talking about how we can look at levels of 30 to 50 thereabouts on the counter going forward as well. So that stock definitely needs to be on the radar as well. In fact, Somit, you had compiled that a note for us in terms of what is Morgan Stanley betting on, what is their rationale. Take us through the internals as well.
Well, if you see, Morgan Stanley has come out with this note where they have maintained their overweight rating on Reliance Industries, and they've hiked the target price to 3,253. Now, do note that this is the highest target price on street given by any brokerage for Reliance Industries. Now, what the brokerage says is that that policymakers are now focusing more on energy security, and hydrogen is expected to be expected to play a major role in this upcoming energy transmission. Now, this heightened awareness of energy security is expected to benefit Reliance Industries hydrogen initiative and will also fund the growth for this business going forward. Now, they're saying that the company's net asset value is expected to boost by nearly 10% because of this new energy initiatives. And on the old energy business, they're saying that the refining business is expected to do well because of the tightness that we have been seeing in the market, and also the gas business is expected to do well because of the higher gas prices. And both these businesses are expected to do well, the cash flows coming in from these businesses will fund nearly half of the capital expenditure required for this new energy business going forward. And they believe that the current share price is not fully valuing in the value that will come in because of this new energy business going forward.
Thanks
very much for giving us those details. Let's connect with the management of TCI Express. Then Chandar Agarwal is the managing director joining in to talk a little bit about the impact of the fuel rise on margins as well as what the outlook is in terms of demand. Mr. Agarwal, good to have you on board. To begin with, we have seen that rise in diesel prices. How do you plan to mitigate the same, and what kind of price hikes is the company looking to undertake?
So, this is not the first time that we've seen a diesel fuel hike. It's been an ongoing process in India. I think since GST was introduced, I think the fuel price was being hiked on a daily basis. So this is something which, we are quite accustomed to. And we have found our ways of, maneuvering around that by talking to customers. And also we had introduced the diesel fuel surcharge. So that really helped in, balancing out these day-to-day, daily shocks, as I must say. So fuel hikes, price hikes. So I think we're quite immune to that. Of course, it's a passover also to the customer, but the way a company can do it is also very critical in achieving that. So, we have our own branches, we have our own manpower, and that's really beneficial in bringing out that increase with the customers.
Okay, fair enough. And Chandar, how are you looking at the outlook for the industry as a whole? Because clearly macro indicators seem to suggest that the logistics industry has now reached the pre-COVID levels. Is that a sense that you're getting, that things are now back to normal?
Absolutely. I mean, we're doing phenomenally well. And I think the important key points is that, first of all, our business, TCI Express business, is driven on the economic growth. So next 10 years is poised to be a phenomenal growth opportunity for TCI Express. And not just, and in the short term, as we look at, the COVID has gone away, and then, and then we're not having so much of all these lockdowns and everything. It's a much clearer path to better top line and bottom line growth. So just to give you an example, for the 10 years, I have TCI Express will have an EBITDA of about almost 3,500 crores and PAT levels of 2,000 crores, and out of which we will be investing 1,000 crores in the next 10 years. Now, all this will be through internal accruals. Nothing is going to be on debt. So I think that itself shows that, it's a good place to be in, and the business is going to be prospering as we go along.
Yeah, this is Nayantara joining in. I would ask you one question, because you were talking about EBITDA, right? And the kind of how you're funding everything from internal accruals as well. So you have a good balance sheet, and we've been reading about that from Jefferies and other brokerage reports. How are you going to continue compete with companies like a Delivery, a Shiprocket, a Picker, or a Page, which are backed by venture capital, have raised serious bucks, as of now are not listed, so they're only responsible to the venture capitalists and other shareholders, and they don't mind burning big bucks and big capital?
So, logistics business is not about big bucks. It's about knowledge. So who has the knowledge? It's about the intellectual property. So essentially, with the background that TCI Express has, we have the intellectual property, which is worth probably $100 billion, if I have to say. So I don't think it's a quotient of how much money one can bring in, because just to give an example, you had the MNCs of the world, they're operating in silos in India. Why didn't they come here with in full swing? They have been operating in silos for the past 20, 30 years. So this is something that, is not going to be easily achievable. Yes, you can have top line growth. I can do top line growth of 20, 30,000 crores, but and have a bottom line of, whatever, negative 2,000-3,000 crore. Would my shareholders be happy about that? Possibly not. So I think I'm not really disturbed by what they're doing, and on the ground, they're not really giving me competition.
I'm going to ask you one question, and this is again from a influential foreign brokerage firm, and I wanted to get your views on it. It says that the stock has re-rated over the years, but is yet to fully reflect a sustainable 30% earnings growth with 25% plus ROE business model. You're talking about the business model. You decide to stay in B2B. You don't want to be in B2C. Your top client concentration is also pretty good when it comes to the revenue mix. So why are we not seeing the reflection then?
So the reflection is there. I mean, if you look at it, CAGR growth of the ROE and the ROCE. So the company listed in only 5 years ago. It had the track record of getting that, financial ratios, what you're talking, for not just now, but for the past 15 years. So this is something which has been static and has been stable. We're already at achieving about almost 40%. We will be achieving 40% going forward, EBITDA growth levels. And I think that is something which, the market will see also.
Okay, Chandra, so that's the word coming in on, why or when will we see that 30% growth come into the picture. But, a couple of future triggers that the street has been talking about is, of course, your newer segments like cold chain and your servicing to the pharma sector. How's that shaping up? And also, if I understand it correctly, you were also looking at automating your sorting centers, and that was expected to reduce the throughput time substantially. What's the update on that?
Sure. So the sorting center is in its trial runs. And I think it's going to be quite glorious when we open it up to the public, with photos and videos and all of that. So, it was started only in the month of March. So I think in full swing, it'll be operational by end of May. End of May. So that, I think the real benefit will start seeing in Q2. This is something which, has never been done on this scale. And later when I'm in Q2, when I talk about it, it'll be quite interesting to see that.
Okay, Chandra, and what about... Sorry, please go ahead.
So the new businesses, of course, the cold chain is a very small proportion. Let's not forget the C2C, which is growing phenomenal, and which is growing like almost 100% year on year, and the rail business, rail B2B business. So I think, it's only a matter of time. We started that business last year, and we'll see the benefits coming in. Like I said, 10 years, 3,000 crore, 3,500 crore EBITDA, and 2,000 crore PAT. So I'm quite confident about that.
Big numbers coming to you from the management of TCI Express. But before we let you go, Chandra, quickly a word on your CapEx plan as well, because the focus was on creating a pan-India presence, and there was a next leg of CapEx cycle expected with an investment of 400 to 500 crores. What's the timeline that we should be looking at, and what will it do to your balance sheet and your debt as well?
So we don't have debt. We're a debt-free company. Everybody knows that. And it's all through internal accruals. The investment is intact. It's all through internal accruals. We will be investing about 1,000 crores in the next 10 years, 500 crores in the next 5 years. So at the moment, our financial ratios are also very good. Our return on equity is about 25% plus. So I think it's all in place. This year already, we will be investing about almost, this year meaning last financial year, we invested about almost 80 crores. And going forward this year, we will be investing about another 120, 130 crores.
Okay, Chandra, we'll let you go on that note. Thank you so much for making time and speaking to ET Now today. Appreciate your insights. With that, we are slipping into a very short break with the news that Nifty continues to hover around that 17,250 mark. A smart up move is what we are seeing across sectors. We'll continue tracking that after this very short break. Don't go anywhere.
Presented by Big, Bold, Beautiful Nissan Magnite. Powered by Ebix Cash. हर खुशी के लिए काफी है.
Big, bold, beautiful Nissan Magnite. Test drive today at your nearest Nissan dealership.
Ebix Cash हर खुशी के लिए काफी है.
ये तो मेरी बात सुनती नहीं. Thank God Amstrad तो सुनता है. Put on the AC.
ICICI डायरेक्ट e-ATM के साथ शेयर्स बेचने पर पैसा 5 मिनट में बैंक अकाउंट में आ जाता है. बोला ऐसा है तो मैनी क्वीन बन जाऊंगा और बन गया.
करो तो ICICI डायरेक्ट करो. Investments in securities markets are subject to market risk. Read all the documents carefully before investing.
Presenting partner Hdfc First Bank, always you first. Powered by CoinSwitch, India's largest crypto app. Sustainability partner GE, building a world that works. State partner Government of Chhattisgarh. Associate partner Amrita Vishwa Vidyapeetham. Insurance partner LIC, हर पल आपके साथ. For a new day partner Toshiba.
Big, bold, beautiful Nissan Magnite. Test drive today at your nearest Nissan dealership.
Indiabulls Housing Finance announces a public issue of secured redeemable NCDs, offering coupon rate of up to 9.25% per annum and additional incentive of 0.25% per annum. Issue is open for subscription. To subscribe, call on 0124 6913 For risk factors and more details, refer to the Shelf and Tranche 1 prospectus available on the websites of SEBI, Stock Exchange Company and the lead managers.
सब्र कर बेटा. नहीं, सब्र का फल कभी डेंगू तो कभी मलेरिया होता है.
हाँ माँ जी, मच्छर जितनी ज्यादा देर जिंदा रहेगा, बीमारियों का खतरा उतना ज्यादा बढ़ेगा. तो मच्छरों के साथ सब्र मत दिखाइए. काला हिट लाइम से उन्हें तुरंत मार गिराइए.
काला हिट लाइम, मच्छरों का अंत तुरंत.
पेश है एम स्टॉक बाय मिरे एसेट. एक बार ₹999 की अकाउंट ओपनिंग फी दें और करिए ट्रेडिंग एंड इन्वेस्टिंग बिना किसी ब्रोकरेज के.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The Global Ayush Investment and Innovation Summit 2022 in Gujarat is the world's first event celebrating the transformation of the Ayush sector into a multi-billion-dollar industry. The path-breaking policy and regulatory initiatives by Prime Minister Shri Narendra Modi have been a game changer. Invest in Ayush for a healthy and vibrant future.
कल जो मेरा वो आधा बांटने का वादा तुमसे और अपनी ख्वाहिशों को पूरा करने का खुद से.
जिन्हें अहमियत है वादों और इरादों की, उनके लिए SBI लाइफ. करो पूरे अपने इरादे, अपनों से किए सभी वादे. SBI लाइफ, अपने लिए अपनों के लिए.
Big, bold, beautiful Nissan Magnite. Test drive today at your nearest Nissan dealership.
Invest in Muthoot Mini NCD and get 10% effective yield per annum on your investment in option 6 of 66 months. To know more, call us now on 1800-2700-212. Investors should carefully read the prospectus dated April 18, 2022 and refer to risk factors in the prospectus before making an investment decision.
गर्मी आई है, किसी ने नाक मुंह सिकोड़ के ये खबर सुनाई है, पर हमें तो इसमें कुछ और ही नजर आता है. इसमें आम, लीची और रंग बिरंगी चुस्की का मजा लिया जाता है. क्रिकेट सीजन सारे मोहल्ले को साथ लाता है. छुट्टियां नानी दादी के घर बुलाती हैं और देर तक गप्पे चलती ही जाती हैं.
आ गए वोल्टास के एसी जैसे फ्रेश एयर कूलर्स, हनीकॉम पैडिंग और स्मार्ट ह्यूमिडिटी कंट्रोलर के साथ इंडिया के चारों कोनों तक ठंडक पहुंचाने.
अब गर्मियों के मजे लो बिना गर्मी के.
Topped engineering, then I topped MBA. Now I am working at India's top pharma company.
Oh, but that company works for me.
On Upstocks, invest in the top companies and make them work for you. Investment in the securities market are subject to market risk. Read all the related documents carefully before investing.
Ebix Cash, हर खुशी के लिए काफी है.
Big, bold, beautiful Nissan Magnite. Test drive today at your nearest Nissan dealership.
Welcome back. Just checking in on the equity markets as the resilience is very evident. You do have a 0.7% move on the index. It's 17,265. The broader markets too in firm fettle. You've got a nice gain being built on the mid and the small cap indices as they're decisively outperforming the frontliners in trade this morning. Take a look at some of the winners in trade today. You've got gains being led by Coal India, Asian Paints, Reliance Industries, as well as TCS, ITC and M&M. They're all upbeat in today's trading session. But cement, the cynosure of all eyes, and we've got some latest developments with respect to Wholesome India's exit and who could be the latest entity looking to buy that. We've got ET reports suggesting that JSW has tapped Carlyle to bid for Wholesome's India cement operations. Let's take it across to Arijit Burman, who joins in from the Economic Times with all the exclusive details. Arijit, what exactly are you picking up?
Well, as you rightly said, JSW Cement is most certainly one of the strong contenders in fray to buy Wholesome's twin assets, both listed companies. We're talking about Ambuja Cement and ACC. Now, the issue is this is going to be one of the largest, if not the largest transaction or M&A in the cement space in India. Almost 10 billion if we also factor in that there will be two open offers, because anyone who buys more than 25% triggers change in management. These, as per our capital market rules, will trigger an open offer for an additional 26% stake in each of the companies. So considering it is such a large buyout, JSW has been tapping several private equity firms, gauging their interest levels to form a consortium or help, get backing or financing for its bid. Now, Carlyle, blue-blooded firm, in the past have looked at various cement opportunities that have come by globally as well as in India, is one such candidate. Carlyle seems to be keen. Negotiations are still ongoing. It's a developing story. It's just been 1 week since we broke that story, but things are moving at a rather fast pace. Remember, the clock's ticking. By month end, JSW has to finance or has to organize financing for this entire transaction. So what we gather is JSW, which is led by Sajjan Jindal, is looking to raise as much as $2.5 billion, which is around 18,000 crores, around 18 to 19,000 crores from private equity groups. Now, for one fund to put so much money behind one transaction is also a little risky, despite the fact that there's been a record capital raising by private equity funds in the last 1 year. So there is also efforts going on to look at Apollo Global, someone who is already in the room an existing investor in JSW Cement to see if they can double down, put more money on the table, and join maybe Carlyle into creating this, major financing that is required for this buyout to get completed.
Arjit, good morning. This is Nantar also joining in. We're talking about the second largest cement group in the country when we look at the two twins in which Holcim has the stake, looking to exit after 17 years here. As you said, if you include the open offers, you're talking of north of $10 billion. My question for you is, just looking at this deal, there are a handful of players that can really participate very seriously. One of them, as you reported exclusively, it's in the newspapers today, JSW Group, maybe with the backing of Carlyle or Apollo if there's a common investor. The question is, how serious is this going to be? You've also got Ultratech. You've also got the Adani Group, which is believed to also be getting ready for a bid. We've seen how Adani in the last year has come out when it comes to M&As, how his share prices have been appreciating, how he's been tapping the markets as well. And from Delhi, maybe Dalmia Bharat could be the serious bidder.
Yes, they could be, Nantara. You're right. But remember, this is not going to be, it's going to be aggressive, competitive, no doubt. But do I see too many players in the fray? I'm not sure. Why? Because let's look at Ultratech. Ultratech's the market leader. Now, for the number one player to buy the number two player, it means dominant market position. So it probably would mean getting under the CCI scrutiny a lot more. Can still they manage to do it? Yes. But then, just like if you remember some years back, Lafarge and Holcim, when they decided to merge globally, in India, the antitrust regulator forced them to sell a lot of their assets. So you scale down only to scale up. Now, that is a possibility. It's far more convoluted. But, if I'm a betting man, would I say that Mr. Kumar Mangalam Birla would just let other competition walk in? Maybe not. Maybe not. But Shree Cement, we do know they have been approached. They certainly have the balance sheet to take on such a large, to bite such a large acquisition. But what we are gathering so far, they are not willing to bite such a big chunk. Dalmia Bharat, again, don't have the balance sheet. You can see, any entrepreneur can obviously go all out and bet their house. But that would also mean significant leverage on the balance sheet. So net-net, the market, net-net, the bondholders will not be happy if you over-leverage yourself. Correct. And, going for an acquisition. We've seen how the market's treated the Tata Group, series of acquisitions, high debt. Many of them then struggled for years to come back out of that funk. We saw that with Tatas and Chorus. We saw that with Tatas and JLR. It's a different story now, but we saw the fallout of those cross-border acquisitions which were funded largely on debt. So that's the issue. Adani, JSW, they are newbies. They don't have the market strength. It's a golden opportunity for them to scale up and straight away be number two. It's a golden opportunity for them. Therefore, they are the most aggressive, but there could be one or two other large Indian corporate houses which we gather are sniffing around. We don't want to speculate here, but these two definitely working. By month end, I think the bids are supposed to go in. So there are talks that JSW and Adani are having with banks for financing, with private equity, for to join, as I said, in a consortium.
So Arjit Bahman, big hint you've given there. You're clearly working on more stories and have some tip-offs on some other conglomerates looking to maybe enter the cement space. But this is the big story broken today. It's on the front page of the Economic Times. We got you the person who broke that story live right here on the market. Many thanks for joining us. The cement pack up and about this entire week, not just because of the Holcim exit and the big deals you're likely to see in ACC Ambuja, but you're seeing price hikes, capacity addition. It's a pack very, very much in focus, and expect that big M&A deal some forward movement expected next month. Well, it's almost 10:30 a.m. So, ladies and gentlemen, that means it's time for our segment Chart Busters. Let's go across to our chartists, Kunal Bothra as well as Naresh Marani, who are joining us with charts that are popping up and they want to share with our viewers. Kunal, you go first.
So, Ambuja Cement is a stock which I'd want to discuss. Looks very attractive on the charts, and it was also one of the buy calls which had given. Many of the cement stocks, are moving quite different from their usual characteristic for themselves. The stock, for example, from Ambuja Cement has also managed to cross back above its 200 DMA. That makes the chart patterns very attractive, and also I think this could be on the verge of a multi-month breakout for the stock over the span of the last, I think, 8 months to 10 months from August highs for itself. So this could be an interesting play over the near term to medium term from Ambuja Cement, and expecting the stock to head back towards levels of 400, 420 over the next few months or so. In terms of stock recommendations, there are two buy calls which I would want to showcase. The first one is a buy on Indian Hotels. I believe the stock is making a strong comeback for itself, building a good base at 235 marks. Would suggest that as a buy. Targets of 255, stop loss at 235. And the second would be a buy on NCC. Very strong comeback from the stock, managed to establish a base at the 65, 66 marks. So would suggest a buy on NCC as well. Targets of 80, stop loss 65.
But we already have numbers coming in from Nestle, and the profit looks like it is a tad bit lower than what we expected. It is coming at 595 crores. We were expecting a number of 610 crores. However, if you look at the management commentary, they say that we have delivered double-digit domestic sales volume, driven by volume as well as mix, which demonstrates their strength of the brands going forward as well. In terms of the total sales this quarter, that has come in at 3,951 crores with a total sales growth of 9.7%. And if you look at the domestic sales growth, that has come in at 10.2%. The company is also talking about how the cost of key raw material and packaging materials are witnessing 10-year highs, and costs continue to surge this quarter, which has impacted profit from operations. So that's the management commentary coming in. Continued inflation is likely to be a key factor in the short to medium term. So the Nestle management is acknowledging the fact that the margin pressure is going to sustain in the medium term, and that's the kind of reaction we are seeing on the stock. It has now slipped down about 3% because the management is saying that continued inflation is likely to be a key factor in short as well as medium term. We are confident of facing this turbulence with strategies of scale, efficiencies, mix and pricing, all of which we will deploy judiciously. Apart from that, the management also talks about how they are seeing sustained strong rural growth performance complemented by strong growth in smaller town classes as well as urban agglomerates. They say that our robust performance in e-commerce continued. The channel grew by 71% and now contributes almost 7% to the domestic sales. So top line number is also a bit lower than what we were expecting. We were working with a number of 3,950. The actual revenue figure has come in at 3,610, and that's the reason we are seeing the negative reaction on the counter. And the margin is something which the management is talking about has been under pressure when it comes to the inflation. And overall, if you look at the demand environment as well, the commentary coming in from the provisional data for a lot of companies suggested that the inflation pressure is now impacting volumes as well. However, for Nestle, they say that this quarter they have demonstrated double-digit domestic sales growth. So we'll watch out for that. In fact, my colleague Winnie has passed through the numbers. Winnie, what do you make of the numbers which the company has reported? What's your first take?
When you look at the numbers, you were expecting a moderate set of numbers, and obviously it is in line with expectations when you look at it. Looking at the margins also, let's see, 23.2% is what the margins has come in at versus 23.8% is what we were expecting. There is a contraction because we are seeing a pressure coming in overall due to the inflationary pressure. There is a pressure on the EBITDA performance of the company. Talking about the e-commerce growth, the channel has seen a 71% growth and now contributes around 6.3% of their domestic sales. Their revenue growth is coming at 11%. Profits from operation surely has, is in line with expectation as well. So keeping an eye out on that. Overall domestic sales growth is at 10.2%. Now I'm just going through as of now the release that has come out of home consumption. They are saying that despite that COVID wave 3 impacting January sales, out of home business has posted better than expected Q1 results for the company. So surely that is one to watch out for as well. and they are continuing to focus on the export side as well. The Indian portfolio, new markets is what they are looking at as well. And in terms of category wise, when I'm looking at it, strong momentum has continued for prepared dishes, cooking aids as well. So surely, you know, that packaged food side is seeing a good growth is what the company has highlighted as well. And cost outlook, giving commentary on that, cost outlook, key commodities like edible oil, coffee, wheat, fuel, they remain quite firm and bullish, and cost of packing material is also high. So increased costs amid constraint, supply constraint could be a concern, and you know, because they are expecting this bullish trend to continue globally and locally. So maybe that could mean that margins maybe could see some pressure going forward as well, because that inflation has still continued. All in all, in-line set of numbers coming in from Nestle as of now. Pressure is building in on the stock as of now when you look at it.
Has slipped almost 2.6%, though has recovered from the lowest point of the trading session. I think it is the miss on the margins which is worrying the street a tad bit, and given the fact they're talking about the commodity pressure sustaining in the medium term is definitely something that will cause a bit of nervousness on the counter. We'll do one thing, we'll slip into a very short break. On the other side, we'll continue chatting with the technical experts on what they make of the markets and their top technical picks, as well as we'll continue tracking the markets for you. Don't go anywhere.
Presenting partner Hdfc First Bank, always you first. Powered by CoinSwitch, India's largest crypto app. Sustainability partner GE, building a world that works. Associate partner Amrita Vishwa Vidyapeetham. For a new day partner Toshiba.
Presenting partner Hdfc First Bank, powered by CoinSwitch. Sustainability partner GE. State partner Government of Chhattisgarh. Associate partner Amrita Vishwa Vidyapeetham, insurance partner Life Insurance Corporation of India, e-mobility partner Electra Green Tech Limited, and for a new day partner Toshiba. Thank you all for joining us and for making this a grand conclave of remarkable orators and news-making discourse. And I hope we're all bright and cheery today, because we have a lot in store for you guys over the next 2 days.
Absolutely. The Times Network, ladies and gentlemen, has been championing the path-breaking editorial missions to bolster India's economy, enable digital transformation, support business, and above all, provide solutions and action plans for progress. To drive these initiatives, Times Network has developed pioneering network properties, of which India Economic Conclave is the flag bearer, one of India's most impactful economic events.
You know, Ankit, little wonder then why India Economic Conclave gets the undivided attention of newsmakers, of the esteemed conclave, remember, was the first intellectual property platform to champion India's $5 trillion aspiration. Now, this became the clarion call by the national leadership for the Indian economy as well, with the Honorable Prime Minister Narendra Modi himself calling for a focused effort to make India a $5 trillion economy.
Absolutely. India Economic Conclave has indelibly established itself as India's landmark economic forum for collaborative, immersive, informative and intellectual discussions involving the best minds from diverse domains covering a range of topics and sectors. Every year, India Economic Conclave is a melting pot of some of the most influential global and Indian minds, and this year, ladies and gentlemen, we take it a notch higher.
In fact, with India making up 17.7% of the world's population, you heard me right, 17.7%, the development and growth agenda of India impacts the world at large. Now, a dynamic polity, a robust federal nation, a staunch judiciary, an apolitical military, and a free nation of laws and rights enshrined in its constitution make for a conducive environment for a vibrant and growing nation. The world's largest democracy, ladies and gentlemen, is today also deemed to be the world's fastest growing major economy.
What a lovely time to be in this country. India at present needs to prove that through its established democratic ideals and soft power ideology, it can deliver on the promise of prosperity that is both inclusive and sustainable. To pursue this agenda, the theme of the 8th edition of India Economic Conclave has been crystallized as the Great Indian Democratic Dividend to realize on our full potential to deliver the aspirations of a new India. Let's take a look at what India Economic Conclave stands for.
India's tryst with democracy, started way back in 1947, has defied the odds to grow from strength to strength, finding strength in diversity, in political accountability and the rule of law. A nation with strong institutions and democratic intuitions, a vibrant polity, a strong federal system of distinct states, a staunch judiciary, its national sanctity protected by an apolitical military, with a system of checks and balances enshrined in its constitution. From being the largest democracy in the world, India has become the fastest growing democratic economy in the world. This is India's great democratic dividend at work. A beacon of hope in Asia, a growing power in the global arena. India's star is only going to shine brighter. With a young population hungry to achieve, a rapidly urbanizing nation, a growing technological powerhouse, a nuclear-capable and spacefaring nation, a strong domestic market of over 1 billion consumers, with ever-increasing participation of its population in the nation's economy and financial markets, a burgeoning business community, growing industrial prowess and vibrant startup hub. The India of today is bursting with potential, poised to leap forward and realize all its aspirations. From being the world's most populous democracy to becoming the world's most promising democracy. The 8th edition of the India Economic Conclave has been dedicated to focus on this mission, to turn this aspiration into action. As we celebrate India's many achievements, we look ahead to chart the path of progress of this great democratic nation on the rise. The time is now to capitalize on the great Indian democratic dividend. Welcome to the India Economic Conclave. Join us in this epic journey.
Okay, with that, ladies and gentlemen, we're all ready to kickstart the 8th edition of India Economic Conclave, and I would first like to invite on stage MD Times Network, Mr. Vineet Jain, to welcome our special guest today, Minister of Information and Broadcast, Sports and Youth Affairs, Shri Anurag Thakur. Shri Anurag Thakur, please.
So if we may request you to please come up on the stage. Ladies and gentlemen, can we have a warm round of applause for our guest here, please? And with that, we would like to mark the opening of the India Economic Conclave with the lighting of the lamp ceremony, which, in fact, we'll just... the lamp lighting ceremony, can we also request CEO of Times Group, Mr. N.K. Anand, to please come up on the stage. We would also like to invite MD and CEO of Hdfc Bank, Mr. V. Vaidyanathan, on the stage.
A huge round of applause, ladies and gentlemen, as we are set to kickstart the India Economic Conclave's 8th edition. Thank you, gentlemen. Mr. Jain, we would request you to please deliver now the welcome address for this august gathering this morning.
Good morning, ladies and gentlemen. I warmly welcome you to Times Network's flagship event, the India Economic Conclave. In just its 8th edition this year, IEC is now an essential date in the economic calendar of the subcontinent. It is a unique thought leadership forum that brings together policymakers, economists, corporates, and key influencers, both Indian and global, to debate and discuss the critical challenges and great opportunities of our times. At $3 trillion, we are the 6th largest economy in the world. And in terms of purchasing power parity, the 3rd largest. We are an ancient civilization, but not one that is paralyzed in the past. We are home to the world's 3rd largest startup unicorn ecosystem, behind only the US and China, which is a testament to India's youthful culture of innovation and entrepreneurship. India is among the countries that are recovering the fastest from the pandemic, and all indicators are pointing upwards, with most sectors reporting equal, if not better, conditions than before. A recent IMF working paper indicates that India has rapidly pulled its people out of extreme poverty in the last decade. We have achieved all of this within 75 years of becoming a sovereign democracy. And that's the most remarkable and heartwarming aspect of this exciting journey. Some countries have grown by stamping out dissent and adopting a brutal top-down approach to grow. Ours, on the other hand, is a noisy and argumentative political process. On the world stage too, we have friends, but are not beholden to any one country. India's vibrant democratic ethos and our independent outlook are what makes it such a great nation. It's neither an easy path nor a shortcut, and it may have slowed us down at times, but that is also what has made our ascent deliberate, durable, and deep. And it has earned us the respect and admiration of the world. What's